Thanks for tuning into the FinTech Flo. I want to give you a heads up that if you are looking for CPE credits, this is eligible for 1 hour. If you'd like to learn more, check out the link in our description to get those credits. Hope you enjoy the episode.
Beware the Ides of March. Julius Caesar didn't really read the warnings. We're not really reading the warnings. History is repeating itself and again and again and again. I feel like it just keeps taking a different form, to be honest. And there's a lot to unpack here. Of course, we're talking about SVB, and we're going to be hopping all over the place, just as a full disclaimer and full disclosure, because there's what happened, what's happening now, what does it mean for the future? There's the accounting aspect of it, the tech aspect of it, the banking aspect of it. And this is a subject that's pretty close to home for us in particular.
Yeah, I think we have some really unique insight here. And we were starting to plan for this episode. It was like, no, the whole thing's going to be about SVB. And here we go. So much so that we had to kick the that's concerning portion up to the beginning of it so we could set some context around what the heck's going on here, because it's a wild ride with some detail and nuance. And we want to get that out on the table before we start having opinions on what should happen going forward.
Yeah, and I think for every step you take when it comes to this case, it just opens 12 doors of different conversations. Because again, you can look back of like, well, how did we get here? Is this like other events in history that have already happened that this is kind of shedding light on, and why is this still happening? Yeah. Then there's, of course, the hypotheticals of the future of like, well, how should we be operating? Is our banking system stable? Does it make sense to have bailouts versus backstops? And I mean,
you can start to have some pretty out there discussions based on what's happening with regulation and how the Fed stepped in and everything. Yeah. But we're going to hop into it. But before we do, I want to set a caveat of what I'm noticing out there is there are a lot of opinions that are black and white. You're on one side of the spectrum or another. I think this is an area there's a lot of nuance and there's a lot of gray area. So we're going to try to decipher some of that gray area and really cut through a lot of the bullshit that you might be seeing out there on social media or whatever news article you read, depending on what publication it's coming out of. You know, this is a tricky situation, a lot of details, a lot of nuance, but I'm excited that we're in a unique position to be able to speak about it pretty intelligently, I would say.
Yeah, and it's still unfolding too as it happens.
It is, yeah.
So with that, we'll get flowing. I am Drew Carrick, the rapping CPA, producer here at FloQast Studios.
Mike Whitmire, co-founder, CEO of FloQast, inactive CPA.
And you're watching the FinTech Flo, special episode on breaking down the SVB crisis. So let's jump into it, of course, with that's concerning, because there's nothing more concerning than the situation that's sort of happening right now in front of us. So we've got here a tweet from Raging Capital Ventures, and I believe we're confirming now the legitimacy of Raging.
It's legit. The first time I saw it, that's a name that could be a meme account right there, Raging Capital Ventures, but it turns out this is a real person, and in fact a short seller here who was ahead of the curve on calling out some issues here. I'll let you read the tweet.
Yeah, so we got here this tweet, and it comes from a short seller, William Martin, and Fortune Magazine actually dropped this in an article. So the tweet started on January 18th, which just shows you how much of ahead of the curve he was. And the day before SVB reported earnings. And that's when Martin's account posted this thread, which began, investors have rightfully been fixated on SVB's large exposure to the stressed venture world, with the stock down a lot. However, dig just a little deeper and you will find a much bigger set of problems at SVB. The article then goes on to say, when the bank experienced an increase in withdrawals from depositors this year, deep losses on sales of some securities created a hole in the balance sheet that triggered its spectacular failure in just 2 days this past week, as a run on the bank erupted among the clientele of mostly young tech companies.
Yep. All right, so let me give a little context here. I think we should probably just start with a little history on Silicon Valley Bank and what they do and the services they provide. So, all right, the bank's been around for about 40 years. It was early 80s that it was founded. You know, it's made it through several boom and bust cycles within the venture capital world. So this is the first time it's had any major issues. SVB is a very unique bank. And one of the things that they're able to do is they are familiar enough with the venture capital world to where they can give really unique loans to tech, to venture-backed companies. So what's challenging to a traditional bank about a venture capital company is if you go to FloQast, for example, we raise money. We raised $110 million in 2021. You don't raise that money just to have it sit in the bank and do nothing with. You raise it to hire a bunch of people, spend that money. You're going to lose money on purpose to grow. It's so common in the VC world. They have a cool term. They call it burn cash. We're just going to burn some cash, not lose money every month. They call it burn in cash. So you're going to burn some cash to grow really fast. Then we'll have some milestone out in the future, call it at the really early stage, it's once we achieve product market fit, we'll give you more money. Or maybe once you get to 2 million of recurring revenue, we'll give you some more money. So you kind of work in this milestone mentality with venture capitalists where it's like, if you show this amount of success, then we'll do the next round of funding, keep you going. We can keep growing from there. And the unfair advantage you have by going in the venture world is, in some regards, it's like, I joke around, it's like playing fantasy business. Like we don't have to run a profitable business. I just have to go out and convince people to give us money, and then they give us money and we can grow really fast. Like we don't have to worry about profitability quite yet as a company, right? Because we're in growth mode. So if you go to Wells Fargo or JP Morgan or anyone and you say, hey, my company's great, I'd love a debt line of $50 million to be made available to me, they'll go, okay, how profitable are you? And I'll be like, I'm not. We're going to burn $40 million next year. And they'll be like, okay, there's no way we're giving you a loan. So that's a traditional bank, which I totally understand. If you don't get it, there's no reason you'd loan a company that's burning that amount of money, anything. Silicon Valley Bank, however, they're so entrenched in the venture capital scene and within the tech space, they know how to make these deals work where they can be successful as a bank. Clearly, it's worked for 40 years. They're doing something right. They understand this. And what they do is they have such good relationships with the venture capitalists that they can get comfort that, we don't need paperwork in place, but I know that if I call my venture capitalist friend at this firm, they just invested in this company. If I can get some certainty around the idea that they're going to keep funding them and keep going, I'm very willing to give out a venture debt loan that might get used at some point in the future, but I'm comfortable not going to lose all my money because that'll be made available. Another unique part of this is, as part of these venture debt agreements, the way they make the economics work is they oftentimes take warrants in a company. And for those not familiar with warrants, it's basically like stock options that are given to a business. So you can grant these around, but it's basically just stock options under a different name called warrants. So you'll take a venture line from them. They'll get some interest from you on a monthly basis. They're really friendly interest rate terms because they like the upside on the warrant side. So they'll take that. So they have this portfolio of warrants. And if you think about every company that's ever raised venture debt, or that's ever raised venture money, there's a decent shot that Silicon Valley Bank had some warrants in that company from early on in the life cycle. So think about every IPO that's occurred. They got a little chunk of every IPO that's occurred over the last 5 years. That becomes really profitable, right? So they figured out how to make it work.
So how much due diligence is a team at SVB doing when these startup companies are coming to them? Obviously, the relationship but is it just all relationship based, or are they actually doing some sort of due diligence of, is this a business that's actually like worth holding on to? Because how many VCs dump money into startups that come up, they go down, and then they disappear?
No, I mean there's a lot. The venture capital game is a lot of these are going to fail, and I'm going to have my home runs. Same deal happens with the SVB. I think a lot of times they rely on the diligence that the venture firm did to make that investment. And it's, again, based on, hey, I've worked with this partner at this firm for the last 15 years, and I trust that they've done their diligence and done this. By the time we're speaking, I'm talking for FloQast Inc., So we close our round, FloQast Inc., we're talking to SVB about a debt line. They're talking to our investors to get comfort around why they made the deal. So they're kind of doing their diligence through them. And then they ask for financial information from us. I mean, we got to provide audited financial statements. We provide SaaS metrics, what people care about. When you sign a line with them, there are a bunch of debt covenants that come around it. So it's not just like free money. You have to be doing certain things. You have restrictions around what you can use the money for. So it's not just like, here you go do whatever you want with this. There are covenants that come along with it. It's just that they're able to get themselves comfortable with the risk because they get a lot of upside through the warrants, and they can kind of de-risk through those conversations with the connections that they have.
Yeah. So I just want to finish up this article that we have on here as well, which goes on to say they had bought all these mortgages at the top of the market and were sitting on massive unrealized loss, is what William Martin said in an interview, and it was sitting right there in plain sight. And I know Accounting Today actually also reported on this, which is kind of getting into the details of the accounting of what actually happened. So like I said, we're going to be hopping around on all the different areas.
Yeah, we're hopping around. Well, let's talk about how their balance sheet got in this situation for starters. So we all know, if you're on the FinTech Flo, you probably pay attention to the finance technology space. So venture capital was wild. And end of 2020 into 2021, just like everyone was raising money, FloQast included. We did 110 million, but you saw $100 million rounds getting closed left and right, 200, 300. I even saw a couple like $500 million rounds getting closed. And what would happen is someone would close that round, ourselves included, and then that money all goes into your SVB account. And part of the reason that happens is just it's kind of herd mentality. Like it is what you do. You put your money in Silicon Valley Bank. It's the bank for tech companies, and that's just what you do. So there's not a lot of great treasury planning around that, but it just all goes into that one bank. And then oftentimes you sign that venture debt agreement that I was telling you about. And the purpose of that is if I raise, let's just make up a number, $50 million, that's going to last me maybe 18 months. I'm going to burn that over the course of 18 months. Let's put in a debt line behind that for $50 million. If you ever need that, you can draw down on that debt line and start to use it for operations. But the idea is that's a backstop to help you get to the next round of funding. So let's say you burn your 50 million bucks, you tap into your debt line, you burn another $10 million off your debt line. It's a scary place to be operating, right? Like absolutely. I don't like doing it. Like we don't do it that way. We've never tapped into our venture debt line before. It's a very just in case thing to have in place. And then you would raise your next round after that. You would pay down whatever you owed SVB, and then you'd have your new operating capital go from there. You'd probably layer in another debt line. So every round, they're getting another venture debt line, maybe some more warrants come along with that, and that's sort of how that works. The other reason you would want to sign one of those, this is more how FloQast would potentially use it, is you sign it, you have all that available, and if you want to go do some acquisition work, you can have that capital available. You're like, oh, I really like this deal. Instead of having to go raise a round of funding to make it happen, you just have debt that's been pre-approved and you're like, oh, I'm going to draw down 10 million bucks and go make this acquisition happen. So that's another use case for it. That's my preferred use case. I hate the idea of using it for operations. That's, like I said, that's terrifying to me. I don't love debt. And in fact, we had not signed a debt agreement with them after our last round of funding. So when all of this started to go down, we were not beholden to one of the debt covenant terms.
Right.
Which is, and this is part of how they make all this work, is when you sign a debt agreement with them, oftentimes that comes with a requirement to hang up a large percentage of your money in the bank, in an account at Silicon Valley Bank, which is fine to a lot of people because the idea of a top 20 bank going out of business was just like impossible. There's no way that could happen. And so that's why people got comfortable doing it. Turns out we were wrong, and a run on the banks is always possible still.
So this seems to be like a very VC tech driven sort of concept, because I remember auditing a bunch of different clients, and there was usually bank confirmations going out to a bunch of different banks, like usually at least 3.
Yeah.
But it seems like all of these companies are strictly in. I mean, we're lucky to have.
We're very lucky. We're very lucky. Yeah. No, it is. There are a lot of accounts. I mean, at Cornerstone, we had when I was there, we had 3 different bank accounts for a little diversification. At FloQast, we had 2, but really the only reason we had 2 is because FloQast Studios is a separate entity. We want to have a separate bank account for it. It's with a separate bank, so we had another bank account set up. Had we not had FloQast Studios, we probably would have had everything in SVB, and that's most tech companies at this point. It's an interesting discussion because then you can be like, well, why don't you diversify your balance a little bit more and protect yourself, FDIC limit and all that stuff. My counter argument is we had $100 million at one point at a cap of $250,000 in FDIC limit. To insure $100 million means I need what, 400 bank accounts?
Yeah.
I don't know how many banks exist in the United States, but maybe that's us having a checking account with every single bank in the United States to cover that risk. The counter argument would be, well, maybe you should just put it in a really safe investment like T-notes or T-bills or something like that. My counterpoint would be, well, that's what Silicon Valley Bank did. It's exactly what they did. So maybe it's not quite as low risk as everyone believes. So it's a really tough spot for a business to be in, because when you have all this money and there really isn't a safe place for it, like what are you supposed to, how can you even protect yourself against that amount of money being in the bank? So it's just a weird spot to be in, and hindsight's 2020. I guess we had 400 bank accounts set up, but that's not the case. So I don't know how to deal with this, like the uniqueness of the SVB situation. And where that plays out, we have a really good slide. I think actually the next slide is a nice illustration of it. Let's keep going. Yeah, here we go. On this slide, let me flip forward on my computer.
This is the U.S. bank loan to deposit ratios.
Yeah, so this is really good. So shout out to our CFO for finding this slide and putting this together. We stole it from him, Razak. I appreciate it.
The source is JPMAM.
Yes. So what you're looking at here is the estimated retail deposit as a share of total deposits. So that's consumer bank accounts. So how much of the money owned by this bank is consumer bank related? And you can see that if you look down here, Silicon Valley Bank, incredibly low, right? They're on the bottom right-hand side there. So less than 10% of the capital that they held was held by actual personal commercial or retail accounts. And really those retail accounts are going to be with founders, VCs, those types of individuals who want a relationship with the bank.
Yep.
So that's a big part of them. And as you look across, you'll notice SBNY is also really low.
Yep.
That was another one that failed through all this, Signature Bank of New York. And then another one we're going to be talking about is First Republic Capital up on the right-hand side. They're also known as First Republic Bank. So you might hear FRB, FRC, same deal. So FRC is just First Republic Capital. That's the ticker symbol. But First Republic Bank is what it's more commonly known as. So FRB there. So they're a little bit unique, but pretty similar. And then this x-axis is really important. So what are the loans plus securities as a percentage of deposits? And basically you want that to be over 100%, right? You want the securities available to pay back the deposits to be more than 100%. And if you look at this, Silicon Valley Bank was in a good spot. They were at 109% available. Right. So that's a really good position to be in. So what the heck happened? What would happen is during 2021, everyone raised money. Ton of money went to the deposits at Silicon Valley Bank. I think their total deposit base went from like 60 billion to like 180 or 200 billion in like a 2-year time frame. Yeah. And I mean, it's wild. And so when you raise money like that, you're going to take that money and you're going to invest it in something. In 2008, that was invested in really shady stuff like mortgage-backed securities, super high risk stuff, like a lot of really, really risky transactions, like deals were being made with our money, quite frankly. In this case, it was a little bit different. Silicon Valley Bank actually bought treasury bonds, which are supposed to be one of the lowest risk asset classes out there, backed by the full faith of the United States government. The problem is they bought it when interest rates were at historic lows. For some reason, decided to lock in to a 10-year period. I don't understand this part of it.
You get a slightly, half a percentage.
This was the mistake, the decision to buy long when interest rates were at a historic
I'm wondering
low.
Who's making that directive of like, this is a good idea to lock up our money in 10-year bonds.
I don't know who made that decision, but I think it is worth noting executives have been turned over at Silicon Valley Bank. So there's this notion around no one lost their job and all this kind of stuff. That's simply not true. Those people have been turned over at this point. So yeah, they bought then, and then all of a sudden, 2 things happened to them. 2 really bad things happened. The venture investment market completely stopped. Like no rounds got done in 2022, right? You look around and it went from boom times to bust times. So what happens is you now have record level deposits. You use that money to purchase long-term holdings in T-notes at a low interest rate. Then your client base starts to draw down on their money aggressively because they're all burning cash. So it's literally just burning money on operations causes your deposits to go down. They have to provide cash to be able to have that happen. So all of a sudden they're in a spot where they have to be selling down their bonds or their T-bills. And unfortunately, I can now go to market and buy that exact same thing, but get a 4% yield on it instead of a 1.5% yield. And what does that mean? That means that your bills are worth less than the market. You are now sharing at a loss or selling them at a loss. So when you start selling them at a loss, that's what kicked everyone into panic mode. So that was when the article came out about, SVB is going to issue $2.5 billion in equity shares to cover the losses on this. That was what started everything. Was once people realized like, oh, are there solvency issues here, right? Is it insolvent? People started, myself included, started freaking out, and that was when basically the run on the bank started. And I mean, it's a run on a bank like has literally never been seen in the history of humanity. It was wild. $42 billion was pulled out of SVB in like under 6 hours.
Remarkable.
I don't know how you handle that as a bank. Like I don't think anyone could have handled that level of run on the bank. So anyway, for some context setting, that's how we got here. It's a very unique bank. Their deposits went up so fast. Then they bought it the worst interest rate time, and then their deposits went down so fast because of the type of companies they invest in. It had nothing to do with valuations of venture companies going down. It's like that's I feel like that's being wrapped in a lot of this. Like, oh, these tech companies lost value, and that's why the shares went down. That's not what it is. It's because of the operating model of the businesses. So anyway, yeah, I think that sets a little bit of context of how we got here, and man, we can delve into it.
And there's
more now.
So there's the two key aspects there, right? There is the dry up of the deposits, which almost feels kind of pyramid schemey, where it's like, well, we are using the new fundraising money to keep covering because we keep investing that money, and then you have to keep on kind of like getting more and more and more. But so I want to talk first before we get into the actual held for maturity securities being these bonds. And there's the whole available for sale versus held for maturity issue. But before that,
the crux of the issue.
Yes. Yeah. And the other symptom or driver here that kind of caused this is, of course, the VCs were like, well, we're cooling off with just pouring money into these startups. Now, from the tech world standpoint, being in the startup realm, what do you think? What was the reason for this just pullback and retraction? Is it because obviously in 2020 there was like, we've got all this money and nowhere to invest it in. They were trying to give away, the VCs were trying to give away money. Now all of a sudden it's like, actually we want to hold on to it. And is there any, because I'm curious about this, is there any loss of faith in some of the investments that they had made in some of these startups? Because there's a lot of stuff circulating online where it talks about, I don't need a doggle that it changes the clock from daylight savings time, right? And there's a whole company model built on just the ability to have like never have to change your clocks again because we'll do it for you.
Yeah. No, there were a lot of investments being made that probably shouldn't have been made in 2021 for sure. I would say this dry up in all of it, it was when interest rates started going up, because the higher interest rates are, the less appealing a growth investment is. Yeah. Because all of a sudden your risk return formula works out a little bit differently. Like, wait, if I'm guaranteed to get 4% a year on my, let's just say you have $100 million, do I want to invest it and get 4% a year, collect $4 million guaranteed? Or do I want to put it in this company that has a 90% chance of failing, but might be worth $5 billion one day? The math just changes and it doesn't take many percentage points to change that formula very aggressively. And it's not like there's also this weird dynamic where so many companies raise so much money and we're in this position, we don't have to look at what they're willing to pay now because we don't need the money. So there's this huge disconnect in what founders and executives still think their company is worth versus what the market thinks they're worth, because you have so much money sitting on the balance sheet, right? And so VCs, private equity, they're willing to make investments now. It's just not in multiples that you would have seen back in 2021, and those multiples are driven by that interest rate.
Yeah,
that lives out there.
So I guess the second part of this is, of course, where do you park this money? Because that was obviously the issue. You get these deposits coming in. Yeah. Nobody needs the loan. I mean, that's the interesting thing. It's like you're offering these debt lines, and I get it because I'm the same way. And I think most accountants are probably the risk adverse. Like, we don't like having debt. Like, I'm paying off my credit card bill in whole at the end of the month. I'm not carrying any of that kind of over.
Yep.
Where do you park this money to have it be worth it? And like, the investment community will hate me for saying it because everybody keeps trying to get sold on, well, you always buy things on credit because then you can use the money that you still have and put it somewhere and make a higher interest rate. And for a while I was like, where the heck are you getting this higher interest rate from?
Well, I think that's an important distinction to make. So there's the cash on deposit. So we raised the 110, we just put 110 into Silicon Valley Bank, and then they take that 110, buy their notes with it, and then they make their money, and that's how they survive as a financial institution and have 8,000 people working for them, and there are 8,000 jobs that could potentially be lost, which really sucks as part of all this. But then there's the venture debt line, which is that money's not going into your bank account. You're simply saying, hey, I now have the option in the future to draw down on this money. So thank you for making this money available to me. I'm not going to use it right now. I'm just going to pay a little bit of interest to make, interest expense so that it's available for me in the future. Then you don't really start paying down more. So it's not sitting in your bank account. It's just sort of a structure where, hey, I can take advantage of that $50 million if I want it in the future, but they're not like giving you a debt line and then taking that and then reinvesting it in the market. It's the deposit amount that you've put in that's all of a sudden becomes the money that you invest.
Yeah, I'm just thinking I would never touch that line in the first place if I had the cash on hand. And
and
for a while everybody had the cash on hand.
And you don't. It's a weird game. I wouldn't be surprised if venture debt went away as part of this whole thing, because I think people will question why they do this now, and I've always been skeptical of it because I look at it and it's like, well, okay, if I have to tap into that, that means we're probably not doing well as a company. And is it better to, the option would be to, if you're looking at the end of your runway, it's going to be like, okay, do I raise money at really bad terms? Do I go out of business or do I sell the company? Or the other option is, do I tap into this debt line, which is not a good look, and you might not be able to raise money, and all of a sudden you're piling debt on. So I don't know if it's the best option. I think, like I said earlier, I think the best use case is if you want to do some M&A activity really, really quickly, having that available to you, but not having to pre-raise it and take dilution and all this kind of stuff. Like that is a nice use case for it, and probably a good argument for interest expense in doing it. But just normal course of operations, I don't think it's something that should be used to keep your business alive.
That's the only case that I could see it. I agree, completely agree. But I think we're learning about human psychology is that besides accountants, everybody loves risk. Because it seems like all of these things happen just because people are like very interested in risk. If you look at this from just a common sense standpoint, we're giving you access to millions of dollars that at some point when you don't have the actual cash and there's no more coming in, you can use when the odds are probably at that point that you're going out of business. Mm-hmm. I feel like a toddler could look at that and be like, well, I'm not going to give money to somebody who's not going to give me my money back.
Yeah. And it was, so the way they look at that is, well, someone will give me the money back because I know these VCs and I trust them and they're going to support the business. And so it's not, so from the banking side, the risk isn't as high because they've put in all the work to understand the ecosystem. That's why they're willing to make those types of that type of debt available, whereas any other big bank's not going to make that debt available. And keep in mind, they've been very profitable as a company. They've made this work for 40 years. It was a different situation that got them there. So the venture debt stuff it's unique. We don't like it as accountants because I don't see a good use case, and we're a little more risk averse, but as a financial instrument and something they've done as a company, it's been very effective despite how insane it sounds to sign one. It does sound crazy. Like, wait, you're going to give this company that's burning this much money, like this amount of capital available? That makes zero sense. And it does from a pure bank underwriting perspective, but they found a unique market that had a need for this. They found a way to get comfortable taking on that amount of risk, and it worked for them really well, man. I mean, that's why they're a top 20 bank, or they were a top 20 bank for a reason.
And the interesting thing is, if you look at this chart here, is guess who is also very risk adverse and is all the way on the left. And we got JP Morgan.
Yep.
They're not giving out those.
They are not. No. See, yeah. But for example, FloQast, we'd be very hard pressed to go to JP Morgan and get a deadline in place. It won't be a thing. And that's not their business model, right? They are very consumer heavy. If you look back at this chart, so the estimated retail deposit share of total deposits, so they're more at that 50% clip, so half business, half consumer or retail. And I would guess that of those business accounts, it's more of the actual profitable businesses who are running real companies and doing that kind of thing. They're not the cash burning tech companies, right?
You just called the real companies versus these mark-to-market idea companies.
No, it's it goes back to my comment around fantasy business, right? If you're just going out and raising $100 million and then burning it, it's not. I mean, it is fantasy business. It's not how it works in the real world. Is the way I joke around, and it's like I've talked about this internally. I joke about fantasy business, and it's like at some point you do go from. And we're at that point at FloQast, you go from operating a fantasy business where you burn a bunch of cash to all of a sudden you become profitable, you go public, you're now judged by investors, you become a real business, you care about EBITDA and stuff like that. It's like, I can't believe it. It's not fun. It's not nearly as fun, but that's how it works because the overall logic is we've seen it work really well. Like all the biggest companies in the world burned a ton of cash to get to be as big as they are. And you can do that as long as you have that economy of scale and you can get things and take over the market really early. Then you get to a point where you're unstoppable and everything becomes cheaper and you can build a bigger business and turn profitable later. And that's SVB gets that game we're in the software as a service space. So that's particularly true within SaaS and everyone gets that that's how it goes. You burn cash early and then at some point you'll make the decision to flip and focus on becoming more of a real grown-up business.
I remember the speech that Rob gave at FloQast Go.
Yeah.
About he's like, well, we're going to burn a lot of money in order to take the hill, but at some point we are going to have to actually make money.
Yep.
In order for this investment to actually pan out.
Yeah, and for those who don't know, so Rob Meinhardt's one of our board members. FloQast Go was a company-wide meetup we had. He gave a presentation on stage about taking the mountain and how we're going to become a huge business, and that's it, and that's how it goes. And I'm a big fan of burning money, mostly because we burn money not because we're operating inefficiently, because we invest in product so much, right? And that's where you would sacrifice. Like if we weren't able to spend as much money, unfortunately, it would come away from probably the product side and the customer side, which sucks. I don't want to do that. I want to keep investing in product. I want to keep investing in our customer success and making sure they're happy and everything, and not have to focus 100% on sales, which is if you had to turn a profit, that's what you would focus on.
Yeah, the VC startup boom I think is fascinating to me because it's very much so. I mean, not that there's not those that exist in New York, because there's plenty, but New York kind of has that older school traditional businesses grouping. You're thinking of your Main Street and Wall Street sort of stuff.
Yeah.
But you come out here, obviously, just Silicon Valley, Silicon Beach, and you've got all these sort of startups that are existing, and it's a different world entirely. And people who have only ever worked perhaps at a startup have maybe a disillusionment even of what it really means to work at a company. I've always warned that. I was like, if you came to FloQast from the beginning and it's the only place you've ever known, if you ever went anywhere else, you would be shocked at I'm somebody who's embraced the culture entirely, and I come from,
you know what it's like on the other side, man.
Yeah. And I know what's on the other side. I was like, wow. I was like, this kitchen's like Trader Joe's.
Yeah, they pay us well, treat us right, all that kind of stuff. It's good.
So this is obviously the whole VC setting up that realm aspect of it. But now we actually get into the investing portion of it, which they mentioned was, the time bomb was on the sheet, on the balance sheet right there. And this was from Accounting Today. That the title is SVB's balance sheet time bomb was sitting in plain sight, and sitting in plain sight is the key aspect there. And I'll just give the brief is with the short position in place. This is going back to Martin, who took to Twitter to post his case, and it was all about how he described the bank's hold to maturity accounting trap, which is referring to a bookkeeping maneuver that allows banks to avoid mark to market losses on bonds it doesn't plan to sell. So you talk about the VCs giving the money to these startups. The startups park their money into SVB. Now they're just going to keep spending it down, which is the one half of the dynamic. But in the meantime, SVB is like, all right, well, we've got all of these assets on our balance sheet now. Where are we putting them? Mm-hmm. And they made the decision to choose the very safe T-bonds.
Yep.
But they did so during a time period when the bonds were at such a low interest rate. And this kind of brought into, and then obviously when the interest rates go up, the bonds are worth less. And so now we're in a situation here where they don't actually technically have to market to market.
Yeah. This to me is the biggest crux of the crux of the issue here. You have this hold to maturity, and it represented, there was a chart somewhere. I think hold to maturity represented like 15% of their 20% of their holdings or something like that. But the problem was it did backstop the depositors. So in my opinion, if you have assets on your balance sheet that are backstopping deposits, that needs to be marked to market. The line was apparently, the guidance stated that you don't have to mark something until you actually go ahead and liquidate it or it matures, which feels totally backwards if you're relying on it to back up your depositors. Yeah. Like that to me should be the rule. We should know the fair market value of something that's going to have to be, if there's a run on the banks and we have to make everyone whole, I have to sell this. If that's true, then we should be marking that to market every single quarter.
I mean, that's one of the, I don't think a run on the banks was ever considered in the accounting guidance, right? It was what is your intention? These assets are ones that we have liquid, they're securities that are available for sale. So we are going to market at whatever the value is because at any given moment, we're planning to be able to sell them if it makes sense and the time's right. All these ones that are held to maturity, the goal in the accounting guidance is that if you're planning to hold it to maturity, you don't have to change any fluctuations because you want to just say this is how much it's going to be worth at term because that's the intent. Mm-hmm. And you end up in this really weird situation where now you have to like kind of carve out certain rules for what the purpose of the held to maturity. Because again, the main goal here is like, obviously if this went the other way, if they had bought these bonds when it was super high interest rate and then the interest rates dropped, now all of a sudden they're worth way more. And should they then be allowed to market that up and be like, oh, we've got, even though we don't plan on selling these, we could, and we could make a lot of money doing it.
Well, what's the most accurate reflection on the balance sheet?
I mean, that's for the AICPA to.
Yeah. Well, my opinion is marking it up and down is what gets you the most appropriate value on the balance sheet.
Right. I guess it's so this is where accounting gets weird because it's designed to protect stakeholders, right? Like at the end of the day, public accounting as a whole is designed to protect the public. So it depends on who you're making. Who are you making financial statements for? Are you making it for the average Joe investor who can't really read them, or are you making it for the people that actually understand what's going on?
Yeah, so it's hard to go into every nuance of it, but I guess just me like taking a step back. So we mark to market various investments, and we do that. I don't know why we wouldn't do that with something just because it's going to be held to maturity. That feels like an odd caveat to make when the reality is it's a liquid asset. You can sell it
now.
That's like saying, well, I plan on holding this laptop to maturity, so why do I have to depreciate it? I'll just take the whole loss later.
It's true.
Why do we draw the line there? And then you dig a step deeper, and it's like that should be especially true when the asset is backing up deposits at a bank. Like it's just, I have a fundamental issue with the fact that we don't mark to market simply because it's deemed held to maturity.
I think the key there you touched on is, can you get rid of this? Is it actually liquidatable? And
we mark to market stuff that isn't very liquid. Like venture capitalists mark to market their private company investments, and how hard is it to mark a private company, especially when like valuations are so volatile all over the place? So they're not, VCs obviously aren't publicly traded, but I don't know why you draw the line at something that's held to maturity. It honestly feels like something where it was like written on purpose to make this a little bit easier.
Yeah, I think, I don't know if it's just like a doubt in the public's ability to read it, because it's like, well, we don't want people to think that but I was just going to say, like, we don't want people to look at the balance sheet and be like, oh my gosh, their bonds are worth so much more now. This is great. Like, I want to invest in SVB, because the average person just sees that and it is what it is, even though they're planning to hold it. But like you said, you can liquidate it at any given moment. So
yeah,
I'm going to be tracking and very curious to see what sort of accounting regulations they decide to implement because of this. Because every time I hear mark to market, I just think back to Enron.
And they use it for very shady purposes, with illiquid assets, right?
Right. Mm-hmm. And they're using it to judge or to put a valuation on an idea that hasn't even executed yet.
Yeah. Well, that's what they were doing it for, ideas. Here we have a T-bill where we know what the rate is every single day. Like even from a just workload perspective, this could be done by one person one day. You just update the spreadsheet with the percentage rate for that day, and book the journal entry, and you change it. It's not a lot of work to make that happen. And so that's why I just don't get it. I'm sure there's some use case where I don't understand it, and maybe it's like, oh, that makes sense for a lot of companies, but maybe we draw a line where if it's going to backstop depositors, then you need to value that thing every single quarter. And the reason I think this would have been important in this situation is, so clearly this guy, William Martin, he was digging deep into the financial statements. I'm sure he was reading the footnotes around, here's what we bought, here's what's in the hold to maturity. It's probably digging through that and like, oh wait, it's held for 10 years at this rate. And then if you're just a savvy investor, you can think about, well, I know the Fed's increasing rates. Those are going to be worth less. They're not marking them to market. There's a looming problem here. And this guy saw this 7 weeks before anyone else noticed it, because he was able to dig deep into the footnotes and figure all that stuff out. Now, if it had just been revalued and was sitting on the balance sheet, everyone's looking at the balance sheet and the P&L. If it was happening on a quarterly basis, more regularly up front, maybe it wouldn't have hit everybody just seemingly out of nowhere. Maybe there would have been a little more foresight into that. They could have done some different planning, risked that. And it might have been more of like a slow decline in the stock price rather than, man, you have a bunch of shorts who figured this out. They put a huge short position on it. And then the news comes out that they have to raise $2.5 billion to cover their deposits, and everyone freaks out. And then they go to zero from there. Like that was an extreme outcome to happen. And maybe if the guidance allowed for problems like this to be presented a little more clearly, a little sooner, you could have avoided the panic. I don't think it would have been good for SVB either way, but maybe it would have meant they didn't go out of business, so we didn't have a panic run on the bank and these kinds of things. So I think guidance could have really changed the narrative here, at least. It wouldn't have solved their problem. It was still a poor investment decision. Like no two ways around that, but maybe just a little more transparency in the guidance could have been. could have gone a long way.
This is very like Big Short-esque. And I mean, it seems like there was like this 3-month window where there's just those who really were able to dive deep down. Because I was going to ask about that, is you have to go beyond just the line on the front of the financial statements and dive deep down into the footnotes, see what's actually being disclosed as far as what makes up these these securities.
And that's what the '08 comparison is so difficult, because that was mortgage-backed securities, like high risk that were not well understood, and you had to dig into the footnotes to understand what were sitting in these assets that weren't being marked. This one, it's like, man, you invested in a treasury bond. Like, come on, it's the safest thing you could do.
So what was the actual triggering event though? Because obviously this went on for a while. Mm-hmm. I would suspect that even leadership at SVB had to know that this was a risk. Otherwise, you're not really paying attention to your own financials.
Yeah.
They could have just not said anything. What was that triggering event that kind of like made it? Because if nobody's pulling out the money, then it's not really an issue, right? Because you can just be like, well, if nobody takes it, then we could just let these bonds get back up to where they need to be.
Let me run you through the FloQast story on Thursday. Exactly how all this progressed. So
Wednesday night, Mike goes to bed.
So Wednesday night I go to bed. We have $85 million at Silicon Valley Bank. I wake up at 6:30. There's an article from our CFO that's been shared with our C-level about how SVB has to issue $2.5 million of equity to cover losses to pay back depositors. And I'm like, wait a minute, what's going on? And so I read this article and I start freaking out, because all of a sudden, is there some risk around solvency at this bank? That's really concerning. And does that mean people are going to start pulling their money out? And immediately, like within 30 minutes, if you look at my Slacks, I'm slacking Razak. I'm like, is there going to be a run on the bank here within like 30 minutes? We got there kind of that fast. So I start speaking with our investors, and to our VCs' credit, there's a lot of commentary around there about how VCs like caused a panic run and all this kind of stuff. And there are certainly a set of VCs who got a lot of hysteria going and caused all of this. All of our investors, I want to just make sure that everyone they were very level-headed about all this. They were not pushing me to pull our money out of the bank. They were sort of deferring to me, and were even proposing like maybe we do half of it. We leave half if we want to feel secure and everything. So our investors were very reasonable about it. Unfortunately, human nature is human nature, and a couple people started pulling money out. Word spread really, really quickly. We made the call to wire out a ton of, so we wired out $65 million to our other account to make sure that was safe. And it was a really tough decision, because SVB has been a great partner of ours. I love working with them. We're probably going to continue working with them in light of everything that's happened now, and we're feeling good about it. But like at the end of the day, there's only one FloQast. I have one FloQast to protect. And if we lost all of our money, that would not be a good spot to be in. And that's sort of that was the calculus I was doing, was like, okay, the risk here is that we lose all of our money. What's the trade-off? Maybe SVB doesn't like me as much. I don't know, but that's totally worth that. That's worth it. Like, to save the business, if I piss off some people, I don't know. That's totally worth it. And that's the risk calculation that we did internally. Seemed like a no-brainer. Unfortunately, we were one of the people who came to that conclusion really early, and we made the call on the wire. And it was even like an hour after we initiated the wire, then you heard the stories of it's not going through anymore, blah, 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 all this stuff. And there was a bunch of panic. And then you wake up Friday morning and FDIC took it over. Friday, trading got halted Friday morning. FDIC took it over, began the process of sorting through all the debts, making sure, understanding what the liquidation process would look like, tried to sell it to another bank. This continued. Then I would say, man, like Saturday, if you're all on Twitter, if you're in the VC world at all, it was the amount of panic being spread around a run on the regional banks was very real. And I will say, from my experience, the run on the regional banks did start on Friday. So First Republic was the second bank. First Republic is a regional bank that a lot of high net worth individuals use. So that's why if you go back to our other chart, FRC here, so you'll see they're not quite as low as Silicon Valley Bank on the the deposits as the retail deposit as a total share of deposits, but still in that 40%, still in that 40% range. So a lot of business accounts, but a lot of high net worth individuals. And you can see from a solvency perspective, they had a really high percentage of assets or securities as a percentage of deposits. So they were over 110% there. People aren't looking at this chart. They're not like, oh, First Republic Bank, they're cool, they're good. Even if they go completely out of business, they can liquidate all their assets and still pay back their depositors. Like, people aren't thinking about it that way. they're just freaking out because there's a run on the banks. And then all of a sudden you start to see pictures of there's a line. I don't know if you saw the one. So we're in Los Angeles. There's a wealthy city here by the name of Brentwood. Mm-hmm. If you would drive by the First Republic Bank in Brentwood on Saturday, there's a line around, like a classic, just good old run on the banks, very, very old school looking. Wow. What was unique about SVB was that on Thursday, everyone could do it electronically. It was driven by social media panic. Information was available so fast. So SVB within a period of like 4 to 6 hours had 42 billion of deposits transferred out of their bank. So their deposit base went from like 180 billion to like 140 billion in the span of a few hours. And there's never been like a digitally empowered run on the bank is like that physically could not have happened 50 years ago, right? That couldn't have happened. So this is the first time in history where it's been able to be withdrawn that fast. But anyway, this extended into the regional banks. All of a sudden, everyone's saying, just move all your money to the big banks, put it in JP Morgan, Wells Fargo, all these other ones, which I don't know if we all want all of our wealth concentrated with 4 banks. I don't know if that's a good idea either, but that was the general sentiment. It was like, okay, every regional bank's going to fail now, so let's get our money out. And that got the hysteria going. So that was what went into the weekend, and then continued panic was driven over the weekend through social media. And then on Sunday, ultimately the Fed, FDIC, Treasury stepped in and said, we'll backstop 100% of all deposits at all these banks. And that seemed to calm people down and actually did like chill out the run on the banks.
Yeah. Now the SVB had these relationships with the VCs, and all of a sudden the VCs are just like throwing them under the bus, and they're just like, pull your money out.
That's some, yeah. There, I'm hard pressed to name names given the world I'm in with everything. Yeah. But yeah, there was a set of venture capitalists that were very clearly just telling all of their companies to pull all of their money. That's why I want to be clear. Like, our investors were not like that. It was I was the one freaking out, and in some regards, they were trying to. Yeah, I do have a bit of a reputation as being a guy who freaks out about things. So there was a little bit of, Mike, calm down, it's fine. And then kind of as things progressed, they were still very, but still very helpful with it and not overreactionary. And so like I don't think our investors caused the run on the banks, but once you get that herd mentality going, you can't stop people. And in Silicon Valley, you have these CFO groups and everyone's talking, and as soon things happen so fast because of the communication trail that goes on and those decisions get made. So anyway, yeah, it was definitely VC played a big role in getting this going, clearly, because 97% of their deposits were held by businesses. So
absolutely. Mm-hmm. So this kind of begs the question then onto this next slide. Mm-hmm. If the short seller investors knew about this back in January, they're able to sort of predict and anticipate this is going to happen.
Yep.
Nobody's, just like the Big Short, they're waving around the flags trying to tell people this is not secure. Nobody wants to hear it. No, we're fine. Everything's great. Almost like take me back to Enron too. They're like, no, come on, they can't. It's always going up. That's just Enron. That's how they do it, right? But they were doing the legal thing by the accounting books of what's permitted per accounting standards. Obviously, we'll see how that changes. Kind of question is, did they know, like, what did Silicon Valley executives kind of know? And did the board know? And so this here is from Forbes. Mm-hmm. Silicon Valley bank proxy shows board's secret year-long risk panic. And one of the quotes from the article was, the sudden free fall is likely not a surprise to the SVB board. In the past 15 months, as top insiders cashed options and sold shares, SVB operated without a full-time risk officer, and the number of board risk committee meetings more than doubled.
Well, I'm not. So I think the part of the suggestion here is that the executives all knew this was going to collapse, and as such, they took the opportunity to sell shares and get out before, they didn't want to go down with the ship.
Right.
I would say that's partly true. This is one of those gray area topics where I think it's really easy to run with it. A lot of people aren't aware that there are these things. What is it? 10.5B plan sales or something. So
we've got like that right here on the next slide, actually.
Yeah. So within public company land, executives selling shares can be viewed as a really bad thing. It shows a lack of faith in what's going to happen with the company. Here's a good example of that. Oh, they sold shares. Why? Why did they know what's going wrong and that kind of thing? Or if you sell too much in one day, it could drop the price of a stock. So generally what happens is executives or investors will set up just planned stock sales, and it can be different frequencies. So maybe like there's some founders who have a lot of their public company and they just sell a little bit every single day. So you kind of just without thinking, we're going to sell X number of shares every day. That's the planned sale. You can do it monthly. In this example, they did it quarterly, the executives at Silicon Valley Bank. So it was part of a planned stock sale that had already been there. So it was just going to happen. It's not like they woke up one morning and were like, oh no, things are about to go horribly wrong. I need to sell a bunch of my shares right now, which I think is how it's positioned by some people. I think there's a little middle ground there. So I think the fair question is, well, why did it take so long for this news to come out, and why did it happen to come out right after this occurred? I think that's the very fair discussion to have, but it wasn't as nefarious as this ship's about to sink. I'm going to completely liquidate here. And it's not like they sold 100% of their assets either. It was a percentage of their relative holdings. So it's not a great look, but it's also not, it's in that gray area bound.
That's the problem with, I think, just looking at the headline, because the last one, the headline,
this is horrible.
Secret year-long risk panic, makes it seem like there's some sort of insider information going on and that it is this evil thing. But again, this is where, shout out to the accounting world, right? Let's elevate it up a little bit. If you have the ability to dive deeper into the financials and know how to look through the footnotes and read the disclosures and know beyond just what is on the front line of the balance sheet or the income statement, you could, knowing the fact that there is this thing called the, what is it? The 1051B plans. Mm-hmm. And they have this, and you had informed me of that there is a standard thing where there's just a periodic stocks get sold as just part of the compensation of the owner of the company, because they're not just going to sit on, I don't know, eventually hundreds of millions of dollars of stock. They take it out and they use it to pay for their house and whatever other stuff they're doing.
Yeah, exactly. And I think that's fair. I think about Mark Benioff, CEO of Salesforce, right? The guy, who knows how much money that guy's worth in Salesforce, but they went public. He wants liquidity to be able to do things in his life with that money. But you don't want to sell everything in one day. It's going to drop. So I think he sells 1,000 or 10,000. I'm forgetting the name, but it's just same amount and goes out every single day. He makes an ungodly amount of money every single day, but it's at whatever price it happens to be at that day. He's not picking and choosing when to sell. It just kind of, you dollar cost average it out over whatever period of time. And so it's not quite as nefarious as it's positioned, but it's certainly not great with the timing of everything. Doesn't look very good. Yeah, and just perception's reality, right?
Yeah. Optics is so important. That's why companies have massive PR.
Yeah. But even accountants, it takes a while to learn this. I didn't learn about this until I was at Cornerstone. We were going public. We were putting together the first compensation report for our executives. That was how deep into it I had to get before I learned about these planned stock sales, even as an accountant. I think as a finance person, you're in the know on it at that level, but even as an accountant auditor, you got to be pretty deep in this stuff to understand this is a structure that exists out there.
Well, that's the problem in general is accounting there's so much going on that you get the theory and you get a lot of the high level stuff, and then you just specialize in whatever your area is, and then that's just the thing that you know. If you work in an accounting department and you're just doing the books, you just know bookkeeping. You don't really know about any of this other stuff. And I mean, even for me, transitioning from working in public to then working in private and to now even adding a startup dynamic, you learn so many different things that until you're actually involved with it, you'll have it doesn't feel real. It doesn't feel like that's not a thing that you can relate to and have context behind. And so,
being in the weeds, to your earlier point about elevating accounting, and if you're an auditor in the weeds, I mean, to suss this out, you'd probably have to be an auditor who has experience in the financial industry. You have a good idea of what's going on. You understand interest rates and investment theory and how all that kind of works together. And then you're skeptical enough to be like, wait, why aren't we marking to market this stuff on a regular basis, and maybe do some implied calculations. So even if you're in the financial statements, that's a lot, because you need to have the finance brain, economic understanding, and then pair that with the accounting knowledge. And reality is you're in the weeds doing a lot of this stuff. You don't have time to do that. But I would say this is a prime example of a situation where, not just going through the motions, thinking a little bit more about could have gotten to this conclusion. I'm not saying auditors could have stopped this because they were doing everything in accordance with GAAP guidance and all of that, so they couldn't have stopped it. But you could have at least gotten an idea of what was going on here. And I'll go back to the other slide about the secret year-long risk panic. I would argue that probably every bank had more risk meetings over the last year, because the interest rates have never gone up as fast as they've gone up. And so I think that's a unique risk thing to address. And I mean, them not having a chief risk officer is certainly not a good look, but I guarantee you every bank was having more risk meetings than they were in the year before that.
I think this is the key for accountants is when you're looking at that work paper, it's not just there's a number there. There's an interest rate there. I just have to do this recalculation, tick and tie, make sure it matches up. There's real substantial meaning behind each one of these things that happens. Because I'm thinking of, I could have probably read at some point a footnote or a disclosure that said, oh, the executives have a 1051B plan. And in my mind, I'm just like, okay, it's just some jargon. There's benefit plans or compensation packages or whatever, not really going the level beyond the words that are on the page. And I think actually embracing the meaning behind it, and again, having the context of knowing something like this exists gives you a different perspective when you are looking at, like, I know for me personally now, if I look at financial statements, they're a lot more interesting to me than they were when I was just looking at it as work that has to get done. This is just a number that I got to tie out.
Yeah.
No, there's a lot of elements behind there that have real world implications that impact a lot of people. And that's why you should really care.
Yeah, like every time something collapses, it's like, hey, auditors, we should remember how important what we do is. It's super FTX, like, for the most prime example, but yeah, even this, it's really important. Accountants need to remember how valuable they are, and auditors in particular.
And for context, I just wanted to read for everybody who's listening. The CEO, which is Greg Becker, he had sold 11% on February 27th, and then his general counsel had sold 19% on February 5th. Again, these are all CFO, 32% on February 27th. These are all part of their normal 1051B trading plans, but just so you have some context over how much is being moved, what's being sold, when it's being sold, and just obviously Silicon Valley was the 16th largest bank at $210 billion in assets.
Yeah, and so like the CEO, so it says Greg Becker, CEO, he sold 11% of his stake on February 27th. So like I said earlier, it's not like 100% got liquidated, and there was a total freak out around that. But yeah, still not a good look. I will certainly say that. Yeah,
and that's 3.6 million in stock just the few days before the collapse. But at least he got it. So this then, we talk about the auditors, it gets us to the next level here.
And this is where we're just ranting so much, we're probably going to cover future slides that you've already put together. So for the audience, you'll have to excuse us because we're just ripping here. We already covered a little bit of this, but sorry to cut you off.
No, absolutely. I mean, it is important to know because every single one of these things has so many layers to it.
And it's so intertwined. Exactly. Everything's so, it's hard to do it in an order of progression here.
Yeah. So you got the situation, you know what the elements were that created it. This is the interesting aspect because you never have a conversation about a financial collapse without talking about, well, why didn't somebody catch this sooner? Where were the auditors? Where was somebody stepping in to like warn everybody? This happened with Enron, right? Because Arthur Andersen's in bed with Enron. Here you have KPMG, unfortunately, getting the blunt of the hit on this situation. So this is an article from the Wall Street Journal, and it said 2 crucial facts for determining whether KPMG missed the bank's problems are 1, when the bank runs began in earnest, and 2, when the bank's management and KPMG auditors became aware of the crisis. So those are the things to sort of figure out when you're examining it, like where are the auditors to blame. But KPMG had given, this is the headline here, KPMG gave SVB, Signature Bank, clean bill of health weeks before the collapse.
So this quote I'm reading, so yeah, common sense tells you that an auditor issuing a clean report, a clean bill of health on the 16th largest bank in the United States within 2 weeks fails without any warning is trouble for the auditor, says Lynn Turner, who was chief accountant of the SEC from 1998 to 2001. That is a fascinating time to be a chief accountant for the SEC, right. I'll tell you, in the middle of a complete tech crash. So that's fascinating. I mean, I get it, but they were also like compliant with GAAP guidelines, and their job is to issue an audit opinion and adherence with generally accepted accounting principles. And if they were doing everything in accordance with generally accepted accounting principles, which they were, it sounds like KPMG did a good job here.
Well, so from a GAAP,
I'm gonna protect KPMG here. This is bullshit. They're getting thrown under the bus.
So look from a GAAP standpoint and from an accounting, how should you account for this standpoint? Yes, they followed all of the regulations that are in place, all of the standards that needed to be followed, right? Held to maturity. If you intend to hold it to maturity, you get to say this is what it's going to be worth at maturity, and that's how it stays on the books. This is where I think there's the opportunity, again, to highlight the accounting profession's ability to perhaps think a little more critically. And again, I'll be honest, if I'm a 23-year-old auditor and I'm working on this engagement and I'm just running through these things and I say, well, this is what's the standard, so at the top of my work paper, it probably says ensure that the value of the bonds, you
rolled it forward.
Right, you roll it forward, ensure that the value of these bonds, make sure you have the list of, make sure all the bonds are there, that sums up to the balance sheet, and then make sure that each of these bonds, you pick 25 of them and make sure that the value that's being shown is what the value at maturity is going to be, because that's what the accounting standards would say. It takes that extra layer, which again, this is where maybe there needs to be more finance economics as part of the curriculum, because you have to be thinking, well, what's the actual implication of this? And this is where there's the whole accounts look backwards. So we just look at what happened last year. They followed the standards. Everything's good. But it's the forward-thinking person that's like, what does this actually mean? Because you'd have to be able to put 2 and 2 together and be like, well, actually, yes, they have all these bonds that are held for maturity, which are in accordance with accounting standards. But what happens if people want their money now and the value of these has gone down?
Yeah. Well, if everyone wants their money at one time, the banking system collapses. Like that's just sort of a risk of banks. Like if you look at the slide where we have the XY axis, JP Morgan doesn't have enough to cover their depositors, but unfortunately they're a different type of bank. They got the FDIC that backs up most of it, so they would be fine. Anyway, the part you could argue around with the audit opinion is, you issue a going concern around these. And so should they have issued we have some concerns about their ability to continue as an ongoing entity. And that requires forward-thinking stuff. Like a going concern assessment is based on what's happened in the past and do we see enough losses to where we think this is going to play out and the company's going to go out of business. But that has to be based on historical results, not I'm sitting here, I'm pontificating about how much our rate's going to change and will they have to sell this, and I don't know how much do they have to liquidate to cover the withdrawals that are occurring, blah blah blah. Like that's a lot of assumption to put on an auditor to make. And I can tell you right now, if you try to take a going concern letter to into an audit committee meeting like that, it would not be met well. And there's so many assumptions going into it. I find it hard to peg the challenge on the. I peg it on the accounting guidance. Really, I think it's not just poorly written accounting guidance.
Sure. I think if there was, now there'll definitely be a highlight of this specific sort of area where you can't have your deposits backed by held for maturity, or you have to at least market that. Because I'm just thinking of all these situations, whether it's 2008 or whether it's 2001. There's always a small group of people that sound like they're absolutely crazy for thinking what they're thinking. The ones who are kind of calling it out, and you see it in The Big Short. I think there was one of the individuals at Enron who was like, "Wait a second, like how are we actually making money?" And for years, nobody's thinking about how are we actually making money. And if you say something about it, then you're deemed, you're just nuts, or you're paranoid or something like that. So even if it was something that kind of came up, I can't imagine them being like, "Oh, that's a really good point. Yeah, we should probably mention something about this."
Oh, for sure. Yeah, that would not be met well at any meeting. And I'll even bet you like people on your audit team would probably be like, "What are you talking about? That's not." Herd mentality is very real, and you're only paranoid until you're right.
Yeah.
It's gonna.
Yeah, that's true. Yeah, it's only a conspiracy until it turns out to be true.
Yeah, it's only a theory until it's true.
So we're already kind of up to date, so we'll just use this to continue going into some of the other articles that actually have come out now regarding.
Yeah, so let's talk about perfect. We can get into how they saved the situation, and this was obviously a really controversial decision. So on Sunday, Yellen and the Fed and the Treasury and I guess the whole government just announced that they would come in and backstop 100% of deposits at all of these banks. So for those who are not aware, the FDIC, this is funny, we're talking about the forming of the SEC on last week's podcast. All of a sudden, it's really coming into play. So the FDIC was created as part of the creation of the SEC. They back up to $250,000 in deposits. Do you know if it's always been $250,000?
I thought it was $100,000 for a while. I thought I remember.
Did they recently increase it? Okay.
It must have been.
It better be.
Yeah.
Like it should be increased on a regular basis given inflation.
Yeah. I'm pretty sure I remember back in the day it being $100,000.
That sounds right.
Stuck in my head. Okay. Just so for context for everybody who's listening, we're looking at a Reuters. Is that how you pronounce it?
Reuters.
We're looking at a Reuters finance article here. After SVB failure, U.S. acts to shore up banking system confidence. And this goes right into the whole banking system question. But quoting from this article, the U.S. administration stepped in on Sunday with a series of emergency measures to shore up confidence in the banking system after the failure of SVB threatened to trigger a broader systemic crisis. The collapse of SVB, the largest bank failure since 2008, sparked concerns over whether small business clients would be able to pay their staff, with the FDIC only protecting deposits up to $250,000. some 89% of SVB's 175 billion in deposits were uninsured as of the end of 2022, according to the FDIC.
And that's what makes them unique, is what percentage of the deposits were uninsured. And it's because it's tech companies plowing their money into a checking or savings account with SVB. And obviously you're raising venture rounds that are materially larger than the FDIC limit of 250 grand. So that's why they were in this unique situation. And it should be made very clear that the bank failed. Like the stock went to zero. A lot of people lost a lot of money. And so there's this debate, or was it a bailout or not? You and I were having this debate earlier, and it's really in the semantics. So I would say, on the one hand, the bankers themselves were not bailed out. Like that stock went to zero. A bunch of them are compensated in equity. We were just talking about how they sold all that before. Well, that's now worth zero. So they aren't out scot-free, and it's like they didn't get bailed out on all this. The Silicon Valley ticker is no longer exists, and all of that has been wiped to zero. So not a complete bailout. The people who got bailed out were the depositors there. And you can argue, well, do tech companies really deserve to be bailed out, by the full backing of the government? I can understand an argument there. So it's a decision of, do you want to teach businesses a lesson and be like, well, you should have done better treasury management, and rather than having all of your money with one bank, you should have spread it out across 400 banks, and now you should learn a lesson. And what we're going to do is we're going to wipe all that money out, and now you're not going to be able to make payroll anymore, and your company is going to suffer, and then all the people who work for you are going to suffer. Do you want to do that? Or do you want to say, we're going to go ahead and backstop all this. We're just going to say we're going to guarantee it. That way everyone chills out a little bit. There's not as much of a run on the bank going right here. And so it was a move to instill confidence, to say we're going to back all of this up. But they didn't actually deploy the government hasn't spent any money to make this happen. So I would say that's probably the big difference between 2008 and right now, is money has not been spent by US taxpayers. It's simply the government has positioned that we will backstop it if this. Now, that needs to be a short-term thing. That needs to go away. This needs to be fixed and changed, and somehow there needs to be a one-off thing just for this objectively fairly unique situation. A run of that scale, I don't think could have been contemplated. And to arrive in a situation where you can have a $250,000 limit, it's not sufficient for businesses. That's another thing that's killing me. It just literally we would have had to have 400 bank accounts to be FDIC insured, and that just doesn't work.
It's remarkable that there's not some sort of separate thing for business entities. Yeah. Because what business is operating at scale, at least, with under $250,000 in the bank?
Nobody. Nobody. And then the argument is going to be, well, you should put it in a safe asset, and maybe do a money market account. You can do a sweep account around that. Maybe you're going to buy T-bills with it. Turns out T-bills maybe aren't the best thing to buy with all this. So I don't know there are a couple, I think, paths forward, but I think for the short term, it was a good move for them to do it. Unfortunately, it didn't cost taxpayers any money. Just to be totally clear, I want to explain my stance on all this. In 2008, I was not a fan of the bailout. I was very much these rich bankers are getting bailed out. They're getting their bonuses. You remember people getting on their private jets to go down to DC for their hearings. And it was just such a bad look with everything. And they were legitimately bailed out financially and kept their jobs. It's not quite the same here. It was making sure depositors were fine. Now you can say, well, like I said, those are businesses and a bunch of rich people who maybe they can learn a lesson and all that stuff. Would have had some implications on the economy, so I thought it was a good move here, and also just stopped the further run on the regional banks that was occurring. If they hadn't done anything, Monday morning would have opened up, the run would have continued, and I don't know how the week would have progressed from there. The counter argument, make a counter argument for you here.
Sure.
Well, the bank was still solvent. The current understanding is that once all the assets at SVB are liquidated, the depositors would get 100% of it back. So let's say FDIC took over, everyone took over, and it was just the process was allowed to play out. The rumor that I heard last week was that on Monday, it was guaranteed that your 250 would be available for you to use. The problem is payroll runs were starting on Monday. That just the timing of it operationally, and so many payment providers, and including FloQast, our payroll goes out of Silicon Valley Bank. Yep. So if you don't have, and our payroll is a whole lot more than 250 grand, that is not helpful at all. It's 1 day of payroll. so it wouldn't have helped us. But there's a rumor that based on the liquidation that had already occurred, maybe 50% of your balance would be available maybe on Monday, definitely by Tuesday or Wednesday it'd be available. So 50% was already back. And then when you start adding up if we go back to, let's go back to the slide with the XY axis.
Yep.
So the loans plus securities as a percentage of deposits, because Silicon Valley Bank was over 100% there, they were in a position even after liquidating those held to maturity investments.
At a loss.
At a loss, even after liquidating that at a loss, probably would have been made whole. Most companies probably would have been made whole. The only challenge is that would be like a 6-month process. So your money's tied up for 6 months, which is problematic for some companies. But honestly, if you got 50% of it being made available to you by Wednesday, I would hope you can exist as a business with the other 50% not being available for another 6 months. So that's the counter argument to why do we have to do this whole backstopping measure? They would have gotten paid out anyway. And if you look at this chart, the same thing holds true for First Republic Bank, FRC. They were over 100. Signature Bank of New York, not as much. They were at 95%. So the holders there probably would have lost some of their money, not all of it, but probably a good portion of it. And then I do find it interesting that JP Morgan, where everyone is sending their money now as a result of this, is actually the lowest amount of loan plus security as a percentage of deposits. So that's the bank where if they went belly up, the difference they have is almost everyone there would not hit the FDIC limit. So FDIC would take care of most of that, and then they'd probably have enough assets to cover anything above and beyond that. So
I mean, the fascinating thing about all of this is the ability to gamble with no downside.
Well, that's what we created. That's what, because all right, then the other part is the discount program, the $25 billion bond discount program that was created by the was it the Fed, or who would have, I guess who'd be doing the Fed would be doing this. So this is the part that I'm not a huge fan of. So they agreed to buy back treasuries at par, regardless of when you purchase them, which is the Fed just taking a loss and putting it on their balance sheet. And what happens? That ends up getting funded by the taxpayer. So it's not a direct bailout. However, there's a slow play in terms of that loss being absorbed by our Fed, that going to our national debt, us paying interest on that national debt. It's kind of a slow play into the taxpayers' pocket. So there is a portion of this that can be viewed as a bailout for sure. That has to go away. That's where you've taken banking, you've taken all risk out of banking. And at that point, it's like shit, I should start a bank right now. Right now. It's a zero risk proposition. This sounds like a great idea.
Yeah. Mm-hmm. Have everybody give me your money. I'm going to go put it in a whole bunch of places. And if I make a bunch of money, then yay for me. And if I lose a bunch of money, don't worry. They got you covered.
Yeah. Like so we were having a treasury discussion, obviously. What do you do with our money afterwards? Yeah. And we were chatting with our CFO internally, and it was like, well, maybe we need to diversify with different accounts, and we'll feel a little bit safer with that. And then should we buy some T-bills with it or something like that? It's like, okay, the safest thing out there. And I said that, and our CFO goes, well, why would we buy a T-bill directly if the bank is just going to be able, why don't we just keep it with them, because they're not going to go under. It's all backed up. If they make a poor T-bill purchase decision, they're going to get bailed out. We're not going to get bailed out. So why not just let them take on what's essentially no risk? And I'm like, man, this is okay. That's the first implication of all this. So what are going to be like the third, fourth order impacts of something like this being in place? So this has to go, in my opinion. It's got to be replaced with something. It's like a fine, very short-term backstop, but it's got to stop now, and we got to figure out some other way to handle this.
I feel like we've just been teetering on the edge of like, obviously this is a really great thing. It's putting a pillowcase on the ground as you're falling out of like a building, so at least you get a little bit or a little trampoline or whatever. You're still like falling, but at least you kind of get caught there. But this, I mean, the widespread total panic that would have happened if there had been a rush this morning. I mean, I was anticipating, I was like, geez, if they don't make that decision on Sunday when they finally made it, I was like, you're seeing the whole economy. That's just the tip of the iceberg of a whole entire collapse of, I'm seeing these images of 1929 of people just like running around like headless chickens, who's losing their jobs and who's trying to just get the money out of the bank and buy gold.
Mm-hmm. Yep. What did crypto do during all this?
Right. I mean, that's the thing. They go back to the crypto.
Crypto was like kind of up, but it wasn't up. I was talking to my buddy about it. It's like, this is crypto's time to shine. If you're not doubling or tripling during a run on the bank, like this is kind of the thing that people thought crypto was for when there was too much printing, and then people devalued the dollar and there was a run on the bank. But that apparently was not quite the best hedge out there. I do think Bitcoin's up a decent amount since it started, but not like I would have expected it to just go through the roof as a result of something like this happening.
Because that's the thing is now people are like, where do we put our money? But I mean, this is just you're compounding this on. You have the FTX thing happens, then you've got now this happening, and it just seems to be every time you find like a little, it's like playing Manhunt or hide and go seek, and every time you find a new good hiding spot, you get caught and you get uprooted, and you got to run and find the next hole.
Where do you hide your money? Well, that plays into one of the memes we have later.
Yeah, absolutely.
As well.
So this article is from The Atlantic. Silicon Valley Bank's failure is now everyone's problem. And we kind of already touched on this, like we said, because it was due to the way that they put the held to market, the held to maturity, and the available for sale securities. And so the questions I was going to originally ask, which we kind of already touched on, is how did the increase in interest rates? What's the mechanics actually of how interest rates cause a balance sheet securities to erode?
Yeah. I think there's a second angle that we hadn't discussed. So for starters, you're selling the long-term bonds that you purchase at a lower value now. So that's one angle of it. But also, we get interest on our bank account with them. So they're having to pay us interest, and they're not making as much on the money that they had loaned out. So they were losing money on just the depositors, as well as people's balance going down with all that. So it's kind of a double whammy. The interest rates getting increased here. The Fed increasing interest rates as fast as they did played a pretty big role in this.
I mean, this makes me think of, well, how do banks actually make money? And not to say that I don't know how the basics of how they make money, but it's like, is it really necessary for them to be? I mean, it seems like all company, even a company that they have a portion of the funds that you use at the company, which you use for investments, right, for your treasury. Individuals do it, banks do it, and then there's the people actually on Wall Street who are certified stockbrokers. Mm-hmm. Everybody's just taking other people's money and then gambling with it and taking a risk and hoping to try to make money from it. But should a bank just be there to hold your money?
That's that. So that's the interesting question that's presenting itself all of a sudden. Because the reason you start a bank is obviously you're starting a bank because you want to make money. It's a private enterprise. And the way you just, I guess we'll do banking 101 real quickly. So you take people's deposits, you then factor it out. So you can loan out, I don't know what the factor rate is anymore, but let's just call it 5 to 1 rate or something like that. So you can take the money that's on deposit with you. You can then loan that out to other people, and everything is fine unless there's a run on the bank and everyone wants their money all at once, right? That's just the gist of it. And so you need to have some financial incentive to convince people to create a bank, because running a bank isn't free. You have to create branches, hire people, you got to build the technology to support these things. There's a ton, how much credit card fraud there is, right? And people are going to say you need to cover those losses around that. So running a bank isn't free. You do need to make money to run that bank. And let's say we got rid of the speculative side of it. And it's like, no, you can't make money loaning out other people's money. That's not a thing that you can do anymore. Okay. Then what would happen is you'd have to pay a fee to have your money at the bank. Right. And that fee would probably be pretty sizable, because you'd have to pay for all those services that are being provided to you. So then all of a sudden it's like, okay, customer experience matters and all this. And that's why capitalism in banking makes sense, because you can get like a better banking experience and it can just be better for you. And then you can have banks that specialize in different industries, like exactly what this is. You have the big banks, which are very general. They can help kind of traditional businesses. They can help retail. They can work with everyone. But a Silicon Valley bank is going to be a little more selective in who they work with, because that's the domain that they know really well. First Republic's going to be different. And you do get different levels of customer service. Like calling up Silicon Valley Bank is way easier than calling up Wells Fargo and getting anything. It's different levels of support. And like, here's the wild thing, is the amount of support that we got from them is kind of what enabled us to act as quickly as we did, where if we were with another bank, we might not have been able to act that quickly. And so, they're just different services. And that's what capitalism ultimately provides, is a variety of options, and people compete against each other and form their little niches and specialize in that. Conversely, let's go all the way to the extreme, and you say, well, banks are completely unnecessary. It's just a place to hold my money. If at the end of the day, it's all backed by the government anyway, shouldn't the government just run branches of banks and that be, and it is what it is, and you go with there? Which, man, there's some merit to that argument. Now, if everything's 100% backed and there's no risk, like there is some merit to a discussion around just banks being government owned.
Could you just imagine walking into the federal bank, which is basically just like the DMV.
You're
scheduling your appointment to try to take money out, and the machine's not working, and so you got to take a ticket and get in line and wait 2 hours.
Yeah, that's it. So you could say, hey, let's nationalize banking now. We're not going to do this anymore, which you could make an argument since we're backstopping everything. It is effectively a national bank anyway. But yeah, the customer experience is going to become the DMV, and I don't know if that's what everyone wants. And then banks wouldn't be able to. Then no one would specialize in these cottage industries, and you wouldn't have like a Silicon Valley Bank to support the tech ecosystem.
Right.
And I mean, whether people like it or not, like venture capitalists and investment in technology companies has driven a material percentage of our economy and our innovation. I mean, if you imagine if venture capitalists never existed in the United States,
we would be so stifled from innovation.
We would
it would kill capitalism.
We'd be screwed. None of these tech companies would exist right now.
Yeah.
Could you imagine if technology just wasn't a thing that really got built? Like, VCs are painted really negatively, especially nowadays, but like they play such an important role in our economy. Yeah. The venture capital should not like be sucked dry and taken away, and these banks shouldn't go out of business. It would be so bad for our long term. And this was a big part of the discussion around, what if none of the money gets returned to the startups? Because I think a lot of it was painted around, oh, big tech is evil, and why are we bailing out? It's like, I think people assumed it was Facebook and Google that were getting bailed. That's not. It's early stage companies. It's like these companies, and they're working on important things for the future. Like you realize companies, maybe they're working on like breast cancer research, or they're working on renewable energy stuff, and they're super early stage, but they still have employees. They got to make payroll. If you all of a sudden you just take away huge lending options from them, you crush the venture capital world. Someone today is working on breast cancer research that's not going to be available to us in 10 years, and we're really going to be kicking ourselves because we got rid of that investment. So it's a tricky thing. Like, I get people being frustrated with the tech space and everything, but it is kind of the main driver of our economy and innovation.
So this kind of talks about is Silicon Valley losing its luster, and this is from the Atlantic Daily. Again, this is just more of the same information, but founded in 1983, this is pulled from the article. Founded in 1983, the bank targeted a particular cohort of borrowers, which we spoke about, which is startups, tech firms, and wealthy individuals. Annie Lowry actually put it, by lending to a number of startups whose ventures found success, SVB became one of the 20 largest banks in the country, which is great. When times are good, everything's great. But in the longer term, the bank became vulnerable to its own lack of diversification. So, I mean, this is it's kind of like the catch-22 where it's you want that personalized service because they understand the startup and the VC and the tech world realm. But at the same time, when you don't have a diversification of assets and the things that you're invested in, I don't know.
Well, I'll tell you this: if SVB goes under and ceases to exist, which we don't know what's going to happen right now, because as it stands, so today on March 14th. They're currently figuring everything out with the FDIC. They've restored it, and I believe they're for sale and trying to see if there's a buyer to take over the commercial arm of it, which I hope there is, because what's getting lost in the shuffle here is there are 8,000 employees at SVB. They're not all executives. It's a lot of people working at branches, lower level with families and everything. This isn't like, it's not a bunch of rich people losing their jobs. That is the reality at SVB. So I hope they stick around. I hope someone buys them. It's still a great brand. I hope they can serve Silicon Valley and the tech needs, because if they don't, someone's going to fill that gap. Like, somebody is going to fill the void at some point here and start providing this. Maybe it's in more of a diversified manner, and that solves part of the problem. But this is not an issue. I mean, it is an issue that they were concentrated, but it's also like a pretty easy risk to mitigate. Right. Do you have to blow up only focusing on tech, or should just maybe you not be signing up for long-term treasuries up front? Like, is the solution to not offer banking services specific to technology companies anymore, or is it a decision to just change how you think about risk and maybe have a risk, chief risk officer as a business? Like, that would be a good idea. So I don't know if this is a throw the baby out with the bathwater situation, but I definitely think you need to rethink how this is thought, and them thinking about risk in a different way, coupled with the change in accounting guidance, I think could actually go a long way.
I mean, this is what you're talking about, where everybody keeps trying to make black and white statements, where this is the factor, this is the problem, or this is the problem, and this is a primary example right here. Like, they're calling the primary cause being lack of diversification. But like you said, if the accounting standards made you actually have to deal with held to maturity differently, then it would be one more transparent. It would have made it a much slower, easier to recover, and more manageable decline of just SVB's value as opposed to an entire collapse, stop the run on the banks and all of that.
Yeah. Unfortunately, we're in a society right now where it seems like gray area and nuance isn't contemplated very much anymore. So maybe we're trying to bring a little bit of gray area to the world right now. But like another change is the big one is how do you get businesses comfortable with holding that amount of money at a bank when FDIC limits are 250 grand? Like it just doesn't work. And so that's another angle of how to fix this is how do we think differently about the amount that's protected for a business versus an individual versus small business? And I was thinking a lot about this. And are you familiar with how FDIC works, how it gets funded and everything?
No, not exactly familiar.
So when you become an accredited bank, you pay into the FDIC. So the banks all pay into it, and then if something happens, if there's a collapse, that's then used to pay it back everybody. So it's a bank funded thing.
Mm-hmm.
The problem is every bank's created, every account's created equal, thought of equal. So my personal account is thought of the same as the FloQast Inc. account, which they are wildly different balances that exist. So maybe there's a rule we change how the FDIC works. Perhaps if you're hosting large business accounts, you pay more into the FDIC pool and have a higher protection account for what are called commercial bank accounts. So I can tell you within the FloQast world, integrating with bank accounts, we've learned a whole lot about bank accounts and how they work. And there are actually two types of bank accounts. There are really small business bank accounts and then commercial bank accounts. And when you become larger, you move into a commercial bank account. So perhaps if you're supporting commercial bank accounts, you pay a percentage of that deposit into the FDIC. You're then able to offer businesses a higher insurance limit because of that, and maybe even charge those businesses a little bit of an insurance premium to recoup some of the cost around that. So I think thinking about the protection limit a little differently and asking people to pay for that, not just give it away for free from the government, but getting people to pay for that and protect themselves is maybe another angle where if you bring that in, increase the protection, that would reduce the risk of a run on the bank. You change the guidance so that this stuff doesn't come out of nowhere and we can actually see it coming forward. Those might be two things that could slow this down really quickly and not cause us to have to just throw out banking.
And then what gives the FDIC the ability to just we'll cover everything?
Oh no, then that rule goes away.
Okay.
Then you say no, we're not good. So sorry, all of this is assuming that needs to go away. Like there needs to be some risk associated with it, but there was clearly a mismatch with a 250K limit relative to tech companies raising $100 million at a time. That's where that disconnect exists. And so we need to solve for that specific use case, not just get rid of everything. And I think there are ways to solve for that specific use case.
I just think people are inherently flawed where there's going to be mistakes, and it just takes one person to make a bad decision at one of these places. Even you paying the higher stuff and we're going to protect all of it. Sure, you're paying the higher premium to us to say we're going to protect all of it for you and you're guaranteed because you're a premier member. I'm still doing the same thing with the money. I feel like, right? You're not, are you necessarily changing what you're doing, or are you just saying, we got you first. You're a primary recipient.
Yeah, you might. So you would keep doing the thing you're doing. You keep running the business, but the difference is that money's now sitting in an FDIC account. You're not allowed to tap into FDIC account as a bank. Okay. So you paid into a central body, and then it just sits there as a custodian account, and that's then used in case of a run on the banks.
So
later.
That's what up to 250 is sitting in there that can't be touched. They can't use that to go buy held till maturity securities.
Yes. Okay. So that's the whole point of the FDIC is that goes to a centralized, that banks pay into the central body, and that sits with them, and then that's used to pay out bank accounts in case they get.
So I guess in theory, are they using any of my money? I have less than $250,000 in my account, so all of it's completely covered. Are they using that at all towards any of their endeavors, or are they only relying on the money above the FDIC insured amount to make all their business operate?
They take all deposits.
Yeah.
At everyone, whether they're above 250 and under 250, and then that's the money that they'll loan it out. Sometimes they'll buy assets that are way too risky, and you end up in situations like this. So that's all just pooled together. But then what I'm saying is they pay a certain amount into the FDIC pool. Mm-hmm. I don't know how that's calculated. I'd be really interested to learn more about that. Maybe if anyone's watching, put in the comments how that works. But they pay into the central body, and then that would pay out. So if there's a run on the bank, let's say your bank goes under, you would get back everything that you had in your account first. Everyone else would get up to their 250 back, and then that's the end of it. So if someone had 500 grand in their bank account, they'd get 250 back. You had whatever, you'd get whatever back, and everyone's.
Sure.
everyone under 250 is made whole. But if you're over 250, you're screwed. Sorry about it. Figure it out later.
Oh, I got the nice reboot required to update your system message. I'm not going to do that now.
There we go.
All right. So we've got now the fun. Let's get into let's lighten things up now after an hour and a half of gloom. Though still on the same topic, of course. So we're going to get into the Reddits. Have you read it? Which is where we're going to take a look here at one of the most interesting, I would say, messages, which seems like a joke, but it's actually a very real thing. Do you want to do a little role play here? Which one do you want to be?
The flea to all right. I'll be the entrepreneur here. So you can all right. I'll be the blue bubble. So you can go first.
Okay. So this is a text message conversation. This comes from Brenna in the accounting subreddit. She's in management. And it's a yeehaw with a coffee cup as our caption here. My lead investor just texted me this about SVB. So I will be the lead investor, and Mike will be founder of the startup. Are you using SVB?
And I reply with, yeah, we're looking into another bank account right now.
Well, our view is that this is a sector-wide issue.
Can I cut you off? Sure. Our view is this is a sector-wide issue is so VC. It's beautifully done. So, okay, sorry to cut you off, but that is like perfect. All right, go ahead.
Our view is that this is a sector-wide issue. We're advising founders not to use a bank right now. We're pooling together our portcos, capital, and executing a large batch transaction for Starbucks gift cards. Starbucks is likely more stable than banks. They're on every corner, and everyone drinks coffee. To cash out, we'll just buy a bunch of those dip medallions, the little cookies they have near the checkout. Best case, we make 98 cents on the dollar. Worst case, we have a few million cookies that have a long shelf life.
It's I love this meme because it was right in the middle of like, okay, where do you flee for a safe haven of assets right now? And I don't know, man, Starbucks, Amazon gift cards, Amazon's not going under. Yeah. Amazon's too big to fail. Should I just buy a bunch of Amazon gift cards instead?
It really brings into question like, well, because I mean, people have been talking about like getting into gold. Like I get texts once a year from multiple people. Should I buy gold? Mm-hmm. Everybody thinks at any given moment, it's like, this is the collapse. This is the end. We need gold. There's all these alternative I mean, could you imagine on the books of your financial statements, just like a few $1 million in Starbucks gift cards?
I would love,
could you put cookies? Cookies an asset?
Are we covering this? I think it's in there because their deferred revenue would just go through the roof.
Oh yeah. So we get on here some of the responses that individuals came. So we'll read through some of these responses that individuals had on that.
I'll go first. So one of them is the Stewie here says, I'll let AP know they need to start adding gift cards to the check run. Yep, spot on.
We got a bedazzling bear here. This must be from Michael Scott. Initials in the text are MS. Only he could have such a brilliant idea.
It's just dumb enough to work is exactly where that's at. All right, and this one's from Golden Icarus. I like that. All right, Golden Icarus. I'm just imagining auditors looking at the trial balance at the start of the next audit and wondering why Starbucks has $1.2 trillion of deferred revenue. Great, that would be pretty amazing. Great flux analysis. A run in the bank led to everyone purchasing Starbucks gift cards. As such, we now own $1.2 trillion of gift cards. Yeah.
Well, that's the flip side, right? Because that's the Starbucks financial statements. Yeah. Because everybody's thinking of like, all right, well, we're going to have a bunch of assets, which is just Starbucks gift cards, or in this case, the cookies.
Accounting for gift cards, by the way, is fascinating.
Yeah.
The deferred revenue around gift card recognition.
That's a whole technical CPE subject in and of itself.
Yep. You'll make a song about that one later.
Yeah, we'll do that. And then we have Anomaly Nexus. To be fair, betting against the pumpkin spice buying horde seems like a bad plan anyway.
Yep, I agree.
This just shows you the hype around Starbucks, but it does make you think about alternative ways of like, well, where can I park my money? Because we said you can't put it in 400. You could, but I can only imagine the administrative burden of doing that.
Greg, our controller, he wouldn't be here much longer if I asked him to diversify under our FDIC limit everywhere. That'd be brutal. He's not going to open 400 bank accounts.
Yeah, no, absolutely not. And so
our auditors aren't going to audit for it. Imagine them sending out 400 bank confirms.
Can you imagine what that audit would be like, having to send out 400 bank confirmations?
Confirmation.com would be doing really well.
Oh my gosh.
Free plug there.
That one of those business models that like they just plugged a hole and lucky them.
Yep.
$125 was what it was when I was.
Is that what they charge?
That was per confirmation.
Good for them. Good for them.
To basically just send an email.
All right. Well, hey, good for them. You can use our Remind product for free now. Go for it.
And then I thought this was really funny from the Morning Brew, which is can't trust the banks or crypto. It's time to bring back a classic. And there's a picture of an individual putting a bunch of money under the mattress.
I think we all have that uncle who has some cash saved in the mattress or in the walls or something like that. You think they're a little crazy until last week, and then they look like the sane ones.
Well, I feel a little crazy because, like I said, Sunday before all of this happened, where like Fed stepped in and said, no, everything's going to be okay. We're going to back up that. You'll be made whole. We're not bailing them out. We're just going to, put this in place to bail out our depositors and make sure everybody's okay on that sort of front. I was like, I was at a music video shoot actually, and I'm telling people at this music video shoot, I was like, guys, economy's about to collapse tonight, so just start preparing for the apocalypse this week. And I was like, very much so. I was like, yeah, I'm probably going to go to the bank tomorrow and just pull out a few $1,000 and just to have
a little cash around
to have on the bed,
just in case. Yeah, go buy some gold.
But I was very encouraged to see the chart from our CFO Razak, which is, I keep my money in JP Morgan like the normal plebeian.
There you go. And, you're feeding the big guys. Yeah. All right. Well, we'll see who buys SVB. I hope they continue to exist. But this is such a fascinating moment right now. I mean, I don't know, and I don't know how to feel about it. It's really interesting because we've talked a lot around the perspective of like why the bailout should have occurred, but then there's the angle of just societally, like why should this? Maybe we shouldn't have bailed people out, and is this the right reflection on our banking system? And man, I get that whole argument too, and I do wonder how it would have played out had we just let everything fail and the run continue, like what this week would have looked like.
Everything aligns up in like all different aspects of life because this is very society related too. I mean, it's the tough love of the parent. Do you let your kid fall flat on their face and have to pick themselves back up, or do you try to protect them to be like, you're going to stifle the potential future of your life if you make this mistake. I can't let you make this mistake. But then they learn that they don't learn how to fail, and they don't know that there's consequences to failing. And then that's how you end up with star athletes who are always protected throughout high school because they're the star athlete, and through college. Now they get to the pros and they don't realize that the rules still apply to them. You can't just drive your car 100 miles an hour drunk and carry around a gun just because you never got in trouble in the past.
Yep. So yeah, do you let everyone learn a lesson and risk the economy, tanking and losing innovation? And is that a risk you're willing to take? I mean, at the end of the day, depositors would have been made whole. So had we just let it play out, so maybe there's an argument for letting everyone fail, learn a lesson, and then get their deposits back, and we would keep running. It would just be a little bit of a delay.
So now would everybody, even those above the 250, have still gotten that back?
Yeah, I think that's the math penciled out to where they had enough to where after liquidating everything, the depositors would have been paid back. Like would it at least 90%, maybe probably 100%.
I mean, I probably would have said so. Basically all the profits and the SVB itself would have been completely tanked, but everybody who was in there would have basically been made whole. The loss would have been incurred on the bank side. Yeah,
the difference. So let's say you let it play out, they would have liquidated the bank. They would have shut the bank down. Everyone gets fired. And over the course of a 6-month time frame, they liquidate every single asset. They sell like all the printers that SVB, they sell everything. And then they recoup that money, and then they give it out proportionally based on how much money you had within the bank. And some of the early calculations came back, it would be around 100%. It would be somewhere in that 95 to 105% range is where it would have been. But that also includes the bank going out of business, all those people losing their jobs. They got to go find more jobs. That's not ideal. Yeah. Under this situation, you backstopped it. You stopped the run on the other banks. You hopefully saved the jobs of all the Silicon Valley Bank employees because now they're in a position to at least get acquired by another bank and keep going. But no one is going to learn a lesson as a result of it. And so what is that worth? And then I think it also appears very unfair, and the fair critique of all this is the government can act very quickly sometimes. And
this is a one day.
To help cover
one day and they jumped in.
It was one day. And then if I'm an average person and you're like, why can't I get health insurance? Why can't we help fix homelessness? Why can't we do like there's very fair questions to be asked around, wait, why can you within a 24-hour time frame turn around and backstop with basically like the unlimited expense of the government and be willing to buy $25 billion worth of bonds at a loss, par value or whatever, but we can't get good health insurance? And that's a very fair critique. I wonder how all this is going to play out in like politics with the election, just general because, 08 caused a rift in society, right? Like I think 08 is still being felt across our society, and this is not going to help in that direction. And so I'm torn. It's a really hard, because on the one hand, like I totally recognize the unfairness of the whole situation and everything. On the other hand, it would have caused a huge disruption in our economy, and I don't know where you shake out with all that. It's such a tough call.
There's a trade-off to any decision that gets made, and it's kind of, we almost need like that hard reset. It's like we go back to the system settings before we added all these crazy apps on our phone, and it started making the phone function weird. But I also use these apps all the time. I was like, can we start again?
I miss the 90s.
Yeah, right? Oh, remember the 90s?
The 90s were great.
Oh,
I was 10. It was way more chill.
So I want to keep laughing. So let's go to the accounting memes.
Oh, well, these aren't funny.
Well, yeah, not so funny. So obviously, this is actually what brings up a really interesting point, right? Because the first one that we have on here, the impact that social media now has, because back in the day, one, you have to physically go to the bank if you want to get your money out of the bank. You can't just go online, transfer it, deposit it somewhere else, use it to buy a bunch of gift cards, whatever. You have to go to the bank, get your money, and then go use it. Yep. But also the impact that now social media has on all of this is you can create that bank run in an instant if just somebody with enough of a following says to go do something. It's like it's a cult, and it's scary.
And there's a lot of debate around this. Like we have a couple tweets on here. We have one from this guy nicknamed JCal, so Jason Calacanicas. He's one of the commentators on the All In podcast, one of the more popular podcasts in Silicon Valley, and just overall at this point, they're like a top 10 podcast. And so he was very much accused of a lot of fear mongering mostly on Saturday and into the weekend a little bit. And I will say, reading some of the tweets, it was like very aggressive. It came across as like, whoa, this is causing a run on the bank, the amount of panic going on here. His defense is, I saw this coming. I'm pulling the fire alarm when I see a fire. Like I'm just being loud about something that is going wrong, and I'm trying to give everyone a heads up, which is a run on the bank. It's like that is the panic that is a run on the bank, just in a digital sphere where you can reach millions and millions of people in a minute. That's the difference with all of this. And so you have the ability to wire out large sums of money. You have the ability to get this information to millions and millions of people in an instant. And I don't know, I can see his argument for why he was freaking out. I can see the argument for people being like, well, VCs wanted to get the government to freak out about this, so they got bailed out. That was the whole purpose of this whole thing. But the defense of Jason here is that he was just alerting to a problem that was going to be hellacious on Monday, and he wanted everyone to have a heads up. And it did result in, I think, him and another one of the hosts on there drove a lot of this, and actually like did spur some action from the government.
Yeah. So this tweet from the 11th, in all caps. So the 11th was Saturday,
March 11th. Okay, so this is on Saturday. Yep.
And it was in all caps. On Monday, 100,000 Americans will be lined up at their regional bank demanding their money. Most will not get it. This went from Silicon Valley insiders on Thursday to the middle class on Saturday. Main Street finds out on Monday. Definitely a little scary.
So very hyperbolic, but also what this is missing is, sure, 100,000 Americans might be lined up at their regional bank demanding money. And he goes, it's gone from Silicon Valley to the middle class and then Main Street. The reality is the vast majority of people in the United States do not have over $250,000 in their bank account. As such, it would not have mattered. I mean, what does happen, the pain of it all is, let's say there was a huge run on the bank. Let's say there was a run on JP Morgan. You didn't get there in time. Mm-hmm. Everything was done. It got locked down and taken over by the FDIC. The pain is that you don't have access to your capital. So if you have bills to pay tomorrow, you're not, if you don't have another account, if you have bills to pay, you're not gonna be able to pay those bills. You got to figure something else out. However, if you let enough time go by, you would have gotten all your money back and you would have been fine. So it's kind of bullshit to say this it would not have cost millions and millions and millions of Americans like their money. Maybe 100,000 Americans is like the number for getting their tops. So I don't know how bad this would have been for like the public at large in terms of losing money. A bit of the counter argument of like, chill out. It's just rich people who are going to lose more of their money. And do you really need more than 250 anyway? I live with less than 250. That's fine.
So it's remarkable. It's remarkable how many people, and this is, I mean, you get into this when you talk about the tax debate. You have a bunch of people. So one of the perspectives that you see often is you have a bunch of people voting in favor of not taxing the rich. Meanwhile, they're not the rich themselves. You have this dynamic of how many Americans listen to podcasts from really rich people talking about how they make rich money moves that only people with money can make.
Yeah.
It's like, well, I was talking to the CEO of JetBlue, and I was like, you should put our movies in your planes. And the average person can't have that conversation. It's like, well, you just got to network and make you're in a different circle of individuals. So a lot of the advice that most of these people give, I think, is not applicable for the average American. And so they get swept up in it, and you just start freaking out. And you're just like, well, if these really smart people are saying that the banks are going to run out of money, and how many average people even know or understand the FDIC limit as a thing? It's just a little disclosure that shows up on the bottom of every bank account.
Probably not. Our financial literacy is not very high in this country. And this is the epitome of just being in a bubble.
Yeah.
It's him and his friends would have been affected by it.
Yeah.
But not 95% of America.
But they made 90% of that 95 think that they were going to be affected. Because again, I truly don't believe enough people have any idea that what the FDIC even is. Or that there is some sort of limit that the money's protected. Like it just doesn't even check out. It doesn't make sense.
I mean, I obviously I knew it was a thing. It was fascinating learning about the proceedings and how it all goes down. That was a really interesting thing to see last week, because I can't remember the last time we saw FDIC actually take over, or I haven't seen the proceedings of it, and we're getting all this behind the scenes information about how it's going to work and how liquidation is going to occur and all that. Sure. So it was really interesting. But yeah, this is you're in a tech bubble. It's going to impact your friends. That's why you're freaking out about it. Yeah. But yeah, even you're able to get someone fired up who's not going to personally be impacted by their bank account, temporarily being froze because they don't have $250 in it. It's a lot of money. This is a lot of freaking money.
This is like outsider trading. That's how I kind of see the social media. You have insider trading, like nobody really knows what's going on. It's just like a couple people kind of getting their money, getting rich. Mm-hmm. The outsider trading, that's what this is, which is just like, I'm going to blast to the world everything that's going on and create like this massive thing. I do want to read the response, because this guy, Austin Lieberman, was going after Jason here.
Yeah.
And his tweet reads, "This weekend was an opportunity for people to learn that at Jason and at David Sachs are out of their minds." These are the two individuals who host the All In podcast.
Yep. Two of the four on the pod. I will say the other two guys were very quiet over the weekend, not doing this stuff.
And it says, "At best, they panicked, and at worst, they intentionally tried to spread FUD. Either way, your mental health and money is better off without their nonsense in your feed."
Yeah, I mean, I'll say I was watching over the weekend and definitely started to, I felt as though it was getting into FUD territory, but what they're talking about is also very real. So
is FUD an acronym for
we're
something?
back. Oh, sorry. FUD is fear, uncertainty, and doubt. Yes, very, very common. So you're spreading fear, uncertainty, and doubt, which is certainly was being spread over Twitter all weekend long. And so there's definitely that, but I also think it was like justified panic, particularly from their world, because they were coming from the startup lens. These guys are both early stage investors. They have a lot of companies that had money tied up in Silicon Valley Bank and weren't going to be able to make payroll. And so I think it was rather justified, but yeah, there's a bit of a over the top panic mode, all caps, things like that being shared. It did reach a little bit of too much of a frenzy, but like at the end of the day, I think they were right that it would have been really bad for the economy. And either way, your mental health and dollars are better off without their nonsense in your feed. Yeah, probably. But I still recommend the All In podcast. I am a fan of it. They make a lot of really good points, and they do see around the corner on a lot of things with this.
That's encouraging at least. But yeah, for the average person, it's like, there's nothing you really can do. You just have to have faith that the people who are in charge are going to make the right decisions and help navigate you through. Because I'm in all these text conversations and all these chats of people. Usually it's just sharing investment advice. And it's like, oh, did you hear about this merger? This is what I think is going to happen. So maybe we'll go ahead and we'll throw a couple $1,000s into that stock.
Yeah.
It's okay.
I'm curious, like your friends outside of tech, what do they think about this whole situation?
Everybody's arguing over, like, you got people from like, oh, it's not a bailout, it's all fine, to people who are like, this is anarchy ready to break out, and this is part of the government's plan to create one single system, right? So you're going deep into conspiracy theory. This is digital currencies taking over, all that stuff. Okay, got it. You got the crypto people who are all like, this is why we need to get into crypto. You have the conspiracy side where they're like, this is the government plan if basically, I mean, we talked about this earlier, what's the purpose of the bank if the government's going to back it up anyway? Then it's like, all right, well, you might as well move to a single system where it's just all, daddy government takes care of me. And then you create this reliance on the government to support all your basic needs and make sure that your money's there. And And then it gets into the whole, well, the government says, well, yeah, you don't even need to hold the cash. Like, you might as well just use all digital, and then you regulate the crypto, and now all of a sudden every single transaction's tracked. And is it a good thing or a bad thing? I mean, I put all my information out there online because if somebody wants it, they're going to find it.
Yep.
I don't have anything to hide. I'm not going to try to hide anything. If you really want it, you can go and get it. But people are like, well, I don't want like them to know like how I'm spending my money.
Or your money frozen.
But you went to Chipotle? You really don't you really care?
What's really funny is there's also this, so within the conspiracy theory realm, it's also like, well, if all my money's in a digital currency, it can get shut down by the government, whatever. Guess what? They can already withdraw money from your bank account right now to get taxes, for example. It's like wild how much control there is. But I went to, so I was hanging out with Chris. And then for those of you who watch PBC, our web series, you'll know Jamie, the audit manager turned SEC reporting manager on our show. I was hanging out with him on Saturday. And I was like, man, I'm really interested how much Josh Simpson's his real name in real life. I was like, I wonder how much Josh knows about this situation. It was like, or how much of a bubble are we in? Like, I was just really excited to hear what he knew about it. And I was like, so he pulls up for lunch. I'm like, Josh, what do you know about this SVB stuff? And he goes, I heard like the CEO sold like $5 million worth of stock the week before, and now they're getting bailed out. And I was just like, oh, okay. That's the narrative that's going to be developing around this. And I think it is fair. I wonder if, coming out of 2008, that was sort of what sparked the Occupy Wall Street movement, the protests, and all the kind of hate that came around for that. I wonder if this sparks some equivalent Occupy Silicon Valley type thing that comes out of all this. Like the social ramifications of this, I think, are really huge, and something that's going to be interesting to see it play out over the next year and a half heading into the election in 2024.
That's why it's so important to have a trusted source. Like, you just have to identify, because you don't have the time to go and dig and all the things. And I don't expect someone like Josh Simpson to be able to go in and teach himself accounting and finance in order to understand the economics of what's going on. But you have to just have a source that you trust that can break it down and get you. Because I would argue that his position on things is probably predominantly what most of the people in America think.
I guarantee you, and rightfully so. Like, I don't think it's, like I said, perception's reality. And yes, they did sell a bunch of stock the week before it collapsed. Like, that it is what it did happen, and as such, it's pretty shady. But I actually don't think there's one person you should trust. I think it's just like, you got to get all kinds of sources. So on this one, it's really interesting. Listen to, David Sachs has great takes on why, despite being, he's pretty anti-government, bordering on libertarian, he still thought there was a place for government to step in here. I would listen to his take on it and be open-minded and hear what he has to say about it. And then head over to, listen to a hardcore liberal socialist person who's like, this is bullshit, and hear their opinion on it. And you just gotta hear all the different viewpoints on all this stuff and get to your own conclusion, because it is in the gray areas where it rests. And I'll tell you, the Mike of 15 years ago, I would have been very against it. If I put any time into listening to a David Sachs or a business person argument around it, I could kind of get to the gray area and begrudgingly be like, they got bailed out again, but yeah, we kind of needed that to keep moving forward. So that's sort of how I feel about it, as trying to take myself out of the CEO of Silicon Valley seat. It's sort of like a begrudgingly like, I guess we had to do this again.
My audit brain has me going back to actually like auditing the news and being like, is this completeness? Because again, all of these stories they're not accurate. They're just a piece of the puzzle, and you can't get a full picture.
Yeah, that's even having one trust. There's no trusted source in my opinion. Is that everyone's going to spin something in their opinion, and so hearing both sides of the table and what different stances are on this, especially with an issue this complicated and this complex, I would highly recommend just like spending time listening to different opinions. My goal here was to try to provide both opinions, like a little bit, try to delve into what I've seen on both sides of it and arrive at the gray area. And like I said, my ultimate conclusion was like, begrudgingly, we had to do this. Yeah. But wholeheartedly, we cannot keep this like discount program in place. We can't just guarantee that we're going to buy T-bills back at par forever for banks. Right. That is nonsense. Like, what's the point of running a bank if you're going to do that? So that has to go away as soon as possible. We got to make other changes. But I don't think SVB should be faulted for being like a bad bank. I think their executives made some bad decisions, and now a lot of employees are going to potentially suffer and lose their jobs as a result of poor decisions made by a few people.
We are at a critical point of making a precedent, and whatever happens now between fixing the accounting standards to help avoid these sorts of things from happening, and then how we approach, and then like you said, optics and perspective is everything. I don't know how much people are going to recover the view on VCs and on tech startups, because all it takes is a couple of headlines to say these tech companies are all overvalued. I mean, we talked about the memes that come from like Morning Brew about making fun of what you do at your tech company job and how you spend most of your day just meditating and like 15 minutes responding to emails, and then you get paid $300,000.
Yeah, it's wild.
But, so there's a lot more scrutiny that I think we'll kind of find out in here.
For anyone who's not in tech and watches those TikTok videos and gets pissed that tech people make so much money and don't work enough, I would encourage you to apply for tech. It's a good. the more people we have applying, the more people appreciate the job and the better it gets. Sure. So I would say apply to software companies. It's a great place to be.
We love the competitiveness. So we've got a meme here. This is from Litquidity. This is Daniel Craig.
Daniel Craig, right? That's that. Okay. I'm not a Bond guy. So.
we've got one here that looks like I don't know where this is from. It looks like he's at a funeral because he's wearing all black, but he's not dressed up at all. So it looks like he's almost in court.
This looks like he just got his mugshot taken or something bad just happened post mugshot, but he's looking terrible. And then off on the right, red carpet, looking good.
Oh yeah.
Yeah.
And that's SVB depositors on Friday versus SVB depositors today.
And I can tell you that's exactly how it was. I mean, I was so fortunate that we got the money out and we didn't have to deal with this level of stress for that number of days. But I can tell you, founders were freaking out. One thing that was happening behind the scenes with VCs, I know they're all evil and horrible and all this kind of stuff, but basically every VC had agreed to find a way to get their company's money and fund payroll on Monday. And they were sending money with like no questions attached, no string. It was just like, here's $3 million, go like make payroll and we'll figure it out later. So like the community itself was actually rallying to make sure payroll was going to be met, which I thought was a pretty cool thing to happen. And it wasn't like oh, you need money, give me 10% interest on this 1 week loan. It was just like, here's money, go make your payroll and we'll figure it out later.
VCs being good human beings, good Samaritans.
Dude, for the most part, they are. That's what sucks is it's like a subset, and maybe we self-select to work with good people and nice people. And I'm very careful with who we bring on our board and everything. But I don't know. My experience working with VCs is they're actually really like good, caring people. I mean, sure, they want to make money, but you're in business, you want to make money. But like, we work on relationships. They're not there to screw each other over. And it's like been a great working relationship with all of our VCs that I've had so far. It was a small subset of the venture capital world that really spurred the run on all this and kind of drove a lot of the hysteria.
So I think the natural question that people would have if I'm listening to hearing that VCs are going to, they stepped in to do the Good Samaritan thing and make sure that everybody was going to make payroll for that upcoming. Where is the money? Where was this money sitting that these VCs had? I
mean, some of it was like the individual VC wiring money out of their own like wealth management account. Like, oh, I use JP Morgan as my wealth advisor. Sure. I have $80 million with JP Morgan. You need $2 million to make payroll tomorrow. I'll wire you $2 million. It was just like literally out of personal bank accounts that people were sending money out of, or if their venture fund. Well, a lot of the venture funds had money at Silicon Valley Bank, so they were also in a bit of this situation, but a lot of them have money with other banks. And so with the other bank accounts, they could wire money to them. And usually there's like a lot of paperwork that goes along with this. You need lawyers involved, you get all this stuff. But that's what I thought was so encouraging was there weren't lawyers involved in these deals. It was just like everyone just being like, yeah, we got to make payroll. Like let's keep everyone alive and start sending money around, and it's all in relationships and doing the right thing. And that was at least an encouraging thing that was happening behind the scenes that I don't think many people are aware of.
It's really encouraging to see that when needed, companies, individuals, even the government in this situation can step up and help solve a problem quickly, not over the course of a whole bunch of time with a lot of casualties, but I mean, I'm amazed by how quickly this was able to kind of get done and how much people can bond together. And the highlight is it shows that there is the possibility to work together and to make progress without fighting when you actually like care about a common problem.
I would just love to see the same level of effort and coordination applied to something like our health insurance in this country. That would be nice.
Yeah. So then we've got here the last meme, and this comes from Reddit user, that Syracuse fan.
All right, there we go. Go Qs. Love it. I'm a Syracuse alumni. There we go.
Not excited if it's true. And it is Matthew McConaughey taking the biggest drag you've ever seen on a cigarette because he is stressed out of his mind. And it reads, FS auditors, financial statement auditors, listening to the speculation around changing AFS, available for sale, and HTM, held to maturity, accounting standards. This is what's going through every accountant's head. The moment that you talk about, we could sit here and talk about, well, they need to make these changes and that, but who actually has to implement those changes when it comes to reality? It's the accountants. It's the ones at the company that now have to switch how they're doing things. It's the auditors who now have to relearn and update all their work papers, and audits moving forward become more complex.
Yep.
It's on them.
I'll tell you, a mark-to-market change in guidance around held-to-maturity securities would be way easier to implement than like ASC 606 or ASC 842, for example. Both of those were massive changes and huge exercises. This feels like it's a workbook with an interest rate. You calculate the par value. What's the difference? That's the other comprehensive, wherever the heck you want to plug that. This feels like a much easier piece of guidance to implement. I get it, but I think we need accountants to book these journal entries.
Yeah, and we do need obviously the update. So I want to educate everybody on what the current accounting for bonds language says. Held-to-maturity debt securities are reported at amortized cost, and this is due to the securities being held to collect contractual cash flows. As such, it would not be appropriate for an investor to recognize interim fluctuations in fair value through a fair value model, since those fluctuations will not be realized by the investor. Obviously, this is where there needs to be the additional language that unless it's backing a deposit.
Yep.
Held-to-maturity securities are subject to an ongoing impairment evaluation under ASC 32620, which states, the biggest difference between held-to-maturity securities and other security types mentioned above is their accounting treatment. As opposed to being recorded and updated on the company's balance sheet according to the security's fair market value, held-to-maturity securities are recorded at their original purchase cost. It means from one accounting period to another, the value of the securities on the company's balance sheet will remain constant. Any gains or losses resulting from changes in interest rates for bonds and other debt instruments will be recorded when the securities reach maturity.
Yeah, that needs to change.
So this is the thing to keep an eye out. This is the thing to look for of, what is this, is FASB? Yeah, that would probably come out with and say, we're making an update to ASC 32620.
This is like, you're supposed to reflect the fair value of something on your balance sheet. Like I used the laptop example earlier. We depreciate a laptop to show you what the fair value of that asset is in a fixed asset account. We don't hold it until, like I can make the claim, I'm never going to sell this laptop. As such, I shouldn't recognize the loss until the laptop is fully depreciated. That's a dumb argument. Why do we make the same argument for a held to maturity security, especially when it's like arguably more liquid than a laptop? Who's going to buy a used laptop? It's like arguably a lot more liquid. And particularly, I think if you had a caveat of if this backstops deposits at all, it needs to be. And maybe it's simple as that. I don't know, but it's got to change. That is so ridiculous to me that it's not mark to market.
I mean, this makes me think hindsight's always 20/20. So we're looking at this now and being like, oh yeah, it's obvious, right? Yeah. But if you were reading this before any of this situation happened and you're just reading through this, is your mind even triggering to be like, well, oh, this is something that could happen. I'm really concerned. I'm wondering right now, if we were to go through all of the accounting standards, would we find something else that's just another maneuver that's just waiting to be exploited? And I guess this is where you get into the whole smartest guys in the room situation, where he looked through all of the standards and found the loophole and said, this is where we can exploit this and take advantage of it until they change it.
That'd be a fun episode.
How many of these Easter eggs are sitting in the accounting standards?
Okay.
Right?
I don't know. So yeah, if we had looked at this before all this happened, I genuinely can't tell you I don't know if I would have had the thought of like, oh, this could happen and this should be marked together.
I'm like, oh, this makes sense. Yeah.
Yeah, that's fine. But yeah, it might be a fun episode to proactively find loopholes in guidance and talk about how you could exploit them to potentially get these things proactively changed.
Right.
That might be an interesting way to approach it.
I think the key would be
how I would commit fraud with this guidance.
I think the key would be maybe we can ask ChatGPT to say, what is the 100 accounting standards that haven't been updated in the last, like the oldest 100 that haven't been updated.
Yeah, that's interesting.
That's where it is. It's
you're right.
Anything that's been updated since 2000 has probably been tightened up. But anything from before that just hasn't come to fruition yet in a situation big enough like this where we're actually looking at it. Those are where you're going to find those nuances.
Maybe we should do a segment. I feel like mark to market is just such an area that presents an opportunity for fraud and risk and everything. Maybe we should really dig into these mark-to-market rules and understand where we think there's some exposure and how it could play out in a shady way.
Valuation in and of itself is such a complex, comprehensive, and confusing. That's why you have valuation specialists, the NASVA or whatever.
It's a whole discipline unto itself. And I mean, you value, you foreign entity values for your company and everything.
You get it with actuaries, and it's how you determine the length of someone's life.
Yeah.
you're a numbers guy. I'm a doctor. I don't was there a crossover?
It's so easy to do a T-bill, like to value it. You know what the par value is. This is like the easiest one. That's what kills me is it's not a lot of work. Like I get McConaughey's a big drag on a cigarette here, but it wouldn't be that big of a deal. It would be nothing compared to 606 or 842.
So
nothing.
So we'll use that to sort of wrap it up because there's so much going on here with this, and I do want to read from the slide that Razak, our CFO, had kind of put together because he broke it down. How was the situation resolved? And this is sort of the key takeaways for everybody who's listening. Solved on here is that the FDIC has taken over SVB, which we discussed, and has guaranteed all depositors while wiping out all equity and unsecured lenders.
Equity investors got wiped out. This wasn't like everyone got bailed out. A lot of people lost a lot of money in this situation.
The second piece here is that any shortfall on funding will be recouped by a bank assessment. And the third way it was solved is that still, not solved, but there's still major question for any company that needs to over $250,000 in a deposit account and if they'll risk using a smaller or regional bank. This is all the stuff that's kind of still to be determined. Where do we put the money? Can we trust would a smaller bank have gotten the same luxuries afforded to them? Mm-hmm. But similar banks will still happen without better guarantees. So he has create a $250,000 FDIC insurance bucket for those who are greater than the $250,000 mark, which is what we sort of talked about, funded by bank assessments, currently $25 billion at par. Mm-hmm. Adjust regulatory requirements on term matching for balance sheet investments, which is the update of the accounting standards. And then adjust reporting requirements for banks with FDIC insurance for quarterly mark-to-market on easily quantifiable investments.
There it is. That will certainly help all these things.
Hmm? So will private banks continue to be necessary?
I think private banks are going to continue to be necessary, and I don't think we want them to be nationalized. I think a nationalized banking system would be pretty lame.
Now, I think as far as whether this week elevated the accounting profession, I think it elevates the role for accountants. I think it showed the flaws in the accounting standards, just having not been carefully considered on a closer eye. I don't know if you can blame anybody because it's like you don't know you have a problem until you have the problem. Sometimes it's hard to forecast every little thing that could potentially go wrong. It's not until you're actually using it. Once you live in a space, then you're like, oh, actually, like I should have put the table over here instead of over there. And it's not till you can envision and try to make your forecast and picture what you think it's going to look like and how it's going to be, but it's not till you're actually there that you see it.
Yeah.
This is just a situation where it sort of just came to light. So, I mean, is it bad for the profession that the accounting guidance sort of backfired?
Good question. I don't know. I mean, I think it certainly elevates the importance of accounting and getting guidance right. And I hope we make changes and get the guidance right as a result of this. Unfortunately, it was no fault of the auditors. It's not like I don't think they really messed up and missed the mark here. In my opinion, it's they did their job. They followed the guidance. Everything was being booked properly. Maybe they gave a risk assessment, but it's not for their job. It's not what they get paid to do. So,
and the unique thing here is like I don't think, and again, obviously we'll see how this plays out and we'll see how movies, document this whole scenario and everything. But it doesn't feel like it's a super unethical sort of fraud sort of situation. It just seems like oversight, overhype, and just obviously the timing of it creates weird optics given the trading plans and all that sort of thing. But overall, this is just. It wasn't like SVB wasn't like, we really want to make sure held to maturity we can keep at the rate. Like this was the standard from well before they had these held to maturity securities. So it wasn't like they really lobbied to make sure that they were able to have this accounting standard. They just did the normal thing. The only flaw here is just the lack of actual critical thinking and sort of only the short sellers it seems seem to figure out. And then I would put a little bit on just leadership for like, you're smart people, you're running this business. You have to start mitigating this a year ago, and there's no excuse for not hiring a risk officer to kind of come in and be like, okay, how can we address this? Because obviously we know it's going to hurt us financially, but there's still an ethical obligation to make sure, like, as much as profits are great and you always want to be going up, and that's always the goal, and you want to report good stuff for your shareholders, there's that ethical component that, like, everybody, even at, when Enron happened, they're like, I was always looking out in the best interest of the shareholders the whole time. It's like, yes, that's like your primary obligation, but there's like, that's in an overall bubble of just being ethical in general to like the general population. Yeah. That I think takes precedent over just your obligation to your shareholders.
Yeah, I think whoever pulled the trigger on committing to a 10-year term on T-bills at an all-time low interest rate is blames pretty squarely at their feet of whoever made that call.
The question is just, are you dumb or are you evil?
That's not an evil thing to do. I really don't think there's anything like evil behind that. It's just a poor investment decision, and for some reason not thinking out in the future, man. There's no excuse for how bad of an investment decision that was at the end of the day, but I don't see how it's nefarious or anything like that. And it's just, why would you screw your own bank? That doesn't make any sense to me.
It just goes to show every 10 years, eventually, we have something really bad happen where we become very risk adverse, and then as things get better, we're like, actually, we can be a little more risky. We can do some non-traditional things, and then it takes one of these things happening again to wake people back up and put them back in their place.
Mm-hmm. So we'll see what the fallout is here, but I think we've proposed a couple potential solutions. I don't know what's actually going to happen here, but hopefully some of what we did happens, and hopefully it's a thing where we can get this behind us and doesn't cause like a huge societal issue, and we can kind of get back to business and do something that works for everybody.
Yeah, and on the next episode of the FinTech Flo, I'm sure we'll have just some updates from how this sort of played out, but we will get back onto the regular accounting stuff. But there's no way to ignore this, and I'm sure whatever proposed standards are sort of brought up and created for accounting, that'll be something that we cover when we're on the show.
I'd love for anyone watching this in the comments, I'd love to hear how you would solve the problem, make sure this doesn't happen again going forward. Like that's what I'm most interested in. What's the solution to this, and how do we make sure it doesn't happen again? Because it's totally unacceptable, and we shouldn't be living in this world right now. So in the comments, how would you fix it if it was your problem?
Yeah, absolutely. So thank you, everybody, for tuning in. If you're watching, thanks for watching. If you're listening, thanks for listening. This has been the FinTech Flo, the SVB crisis broken down by myself, Drew Carrick, and Mike Whitmire. Thanks for watching.
Fun episode, Drew. There we go. Thanks for tuning in, everybody. Appreciate it.